move or M&A move, which might be a fit for a lot of companies, you are categorically saying that you are out of the picture out there, right?
That's right. As of now, we are out of the picture.
As of now, I mean,
Yeah.
sorry, the street may read a lot more than what you want to imply. Can you clarify there?
No, so basically, we haven't put a bid there, for the time being, so that's how it is, so from that perspective, we are not in the race, as of now. So, but if things change, if they don't get something, better, then maybe, we will take a look at it again, but as of now, this is how the status is.
Okay, so not a strategic fit, but if they don't find any buyer or if the valuation drops a little bit, nothing stops you from re-evaluating. I'm presuming that's what you're trying to say.
That's
okay.
Right.
Yeah, I didn't want to misquote you. Okay, thank you for that. The second point is this about operational metrics. Now, you yourself mentioned in the response to the first couple of questions that you are trying to expand reach in certain areas where you may not have been present, etc. And you've gained market share. Is all of this happening at a small cost on operational metrics, quote margins, part one? And would you continue doing that? Because maybe the game demands that right now. So would growth in distribution and volumes happen at the cost of margins? And would that be a conscious strategy?
So, initial investment has to be made, but that is very small compared to the overall size of our company. So, therefore, this can be sustained, and we will continue to sustain this and continue to invest in this. So, there were always, a growth engine which happens, on its own, it keeps generating its own revenue and profit. And then a part of that is to be invested in certain new areas and new ideas which have a possibility of growth in the future. This we look at as a future growth opportunity along with construction, chemical and waterproofing. These two areas will give us, quite a higher growth rate than what the normal growth rate is. And this will drive up the growth for the company as well and the profit for the company.
Mr. Roy, in terms of prices, you did take some product price cuts in the financial year, and you saw that impacting your gross margin. What has been the price outlook for this quarter and going ahead? Are you expecting price hikes, or will you continue to have to cut prices to stay competitive?
So much of the pricing decision is taken, at the mass end by the leader, so we have very little choice there as such, if you ask, from the mass segment. But if you look at the premium and the luxury segment, there is a lot more flexibility there, and, one has the ability to either take the prices up or, don't do anything at all. Depending, as of now, the raw material prices haven't really gone up. In fact, it has softened a little bit. But the dollar has appreciated against the rupee, so it neutralizes that benefit. So more or less it is stable. As of now, I don't think there is any need for either a price increase or a price decrease on any of the major product categories. So this is how I would place it.
In terms of input cost, you talked about both, obviously crude and dollar. How do you see these impacting your fourth quarter? Because both becoming fairly volatile, especially the dollar pressure now only increasing.
So we will maintain our margin. We have always guided that it will be in the 15 to 17% range. This time it was at 16.2. We should be somewhere around that even in the fourth quarter. So we don't see any dilution in terms of the margin as a percentage to sales. It will probably remain or maybe a marginal improvement as well from where we are.
Mr. Roy, a slightly longer term question, if you will, but from most paint companies being largely paint companies, and there might still be the case right now in the case of the overall top line and the share in the overall revenues, but are doing a slew of products between the walls as well, right? Just trying to think in your own strategy, as we sit at the end of FY25 and you look at the next 5 years, if a decade is too long a time frame, do you reckon that every paint company will be a paint plus other products, and those other products contribution overall to the console numbers will be much larger than a minute 5-10%? Could it be almost a 50-50 over a 5-7 year period?
So, as far as we are concerned, I can't speak about others. As far as we are concerned, we will be in paint and coatings, which is basically industrial and decorative paints, and waterproofing and construction chemicals. We are not there in bath fittings and tiles or, any of the other categories that you are talking about, the other spaces that you want to occupy in a home. We are very, very focused on paint and waterproofing and construction chemicals. And in the next 5 years also, I can assure you that we will be focused on these two areas. Now, waterproofing and construction chemical as a category is growing at a faster pace, largely because it is coming from a very low base, and therefore the growth rate is likely to continue in the next 5 years. From current levels, therefore, of around 10-11%, that might go up, but it will definitely not go up to 40-50% or something like that, but it will go up. Maybe it can go up to 17-18% over a 5 year period, and that's where it will be. Predominantly it will still be a paint and coatings play.
Okay.
All right, thank you so much, Abhijit Roy from Berger Paints there, sounding fairly positive in a space which is otherwise not shown that kind of a mood. Well, unfortunately, can't say that for the markets. Berger Paints 1% up, but look at the rest of the street. It's looking quite painful, to be honest. The losses on the Nifty deepening. The Bank Nifty also 1% down. It's the small caps though that are hitting badly. 3% on the small cap 250. I just want to pull up the advanced decline ratio just to give you a sense of how bearish the market is right now. And that pain point continues completely. I mean, the ratio is completely skewed. 2127 to 168 on the NSE 500. The Nifty also looking in a fairly bearish trend. This is going to be another one of those tough days, Neeraj. And no matter how many mutual fund managers come up and try and talk up the markets, there is fear there. Something very, very, I think, solid needs to come in and calm those fears.
Yeah, one shall us to think what it could be, because simply speaking, from a high of 57,703, the BSE small cap index, that is, to today's number of 45,940, we are virtually 20% down, nearly there, if not already. And therefore, technically speaking, we are in a bear market. Portfolios will tell you we are already there in the bear market, but this is painful. This is really painful, and this is in some sense scary. Now, which is what we discussed in the morning, Tamanna, that sometimes when things turn on a dime, it just doesn't stop at the turn off of a tap. It probably takes its own time.
But this is the thing. In the last couple of years, Neeraj, any downtick for a couple of days is getting bought into.
Yeah.
I don't know. This one feels different. It could be a deeper end which is coming in, because what are the positives out there? Maybe Thursday, Friday, like you said, some positive news coming out of the Modi-Trump meet. But to what extent can it really stem this concern? I'm not sure. I mean, just look at some of the big losers before we get into that break. Kirloskar Oil about 11.5% down. Sri Renuka, I think the entire sugar pack is in a world of pain. Look at a Vodafone. I mean, in so many portfolios right now, the Vodafone stock about 8% down. Ircon nearly 8.5% down. These are painful times for anyone's portfolio. But, well, they say that the winners are made at the toughest times. I don't know if you're feeling like a winner today, but we'll take a very short break. We're coming back with more updates and a great conversation on the other side to give us some sense of what next in this market.
regime for individual. In fact, there has been discussion on how to sort of reduce the tax rate.
I am now happy to announce that there will be no income tax payable up to income of 12 lakh rupees.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit's research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Okay, now we are down 20.4% on the small cap index from the December peak, closing level by the way, not intraday. So officially in the small cap space, we have entered the bear market. I must tell you, portfolios or individual retail investors will tell you that the portfolios were in a bear market since long. But this has now officially happened at the BSE small cap index. I mean, you can argue Nifty small cap 250, but I'm using the BSE small cap index as an example. That one is now officially in a bear market. So from the peak to the trough, anything below 20, anything corrects 20%, it becomes bear market. Those rules need to be changed, by the way, because I mean, a lot of times these indices now correct 30% like there is no tomorrow, and at times even a 15% fall feels like a bear market. So keep that in mind. But going by the nomenclature, we are now in the bear market for the small cap index. This is really painful. By the way, if small caps have done this, Nifty isn't too far behind.
You know, and so this is where it all ties into those comments about small and mid-cap funds. And for the many episodes of the mutual fund show that we've done, Neeraj, and whenever we've talked to viewers and we've taken viewer queries, I'm just putting it in tandem with that. How many coming and saying, I want to put money in a small cap fund? There's 70-80% of my portfolio is in a small cap fund. I mean, obviously that's not everyone, but just the sheer number, just from the volume of messages we're getting, is giving a sense of how skewed it is. All right, interesting piece now from Samit. The Nifty has declined 2.4 so far, 2.4% so far in 2025. I suppose with the updated figure, it'll be a little more. But big bulls have also lost a ton of money, about 6,000 crores. So you're not alone if you're looking at your portfolio and wondering what happened. Samit joining in for more details.
Well, as the top 10 big bulls in the market have lost close to 6,000 crores so far in 2025. And one of the big bulls, Radhakishan Damani, is the only one which has seen a green, in fact, an uptick in its portfolio, but that is largely because of Avenue Supermart's share price gain that we have seen so far in 2025. Now, if you remove Avenue Supermart's, even Radhakishan Damani has lost around 13% of its portfolio, and the top 10 bulls have lost close to 9,300 crore rupees. Now, coming to the top 10 bulls of the market, Radhakishan Damani has seen an uptick of around 2.6% in its portfolio. Ashish Dhawan has seen the least decline of just 9%, a 300 crore downtick in his overall portfolio value. Apart from that, if you look at the portfolio of the Jhunjhunwala family, they have lost close to 6,000 crore rupees, that is 9.1%. Ashish Kacholia's portfolio is down by around 300 crore rupees, around 11% downtick in its portfolio. Mukul Agarwal has seen a downtick of around 11.6%, while Akash Bhansali has lost close to 900 crore rupees, that is 13.5% 12.5% downtick so far in 2025, followed by Nimesha, who has seen a downtick of 14%. Madhusudan Kela's portfolio is down by around 500 crore. That is a 15% downtick in his portfolio so far in 2025, followed by Vijay Kedia, who has seen a downtick of 15.5%, and Sunil Singhania has seen the worst performance so far, around 17% down. That is his portfolio so far in 2025. Now, which are the stocks that have hurt them the most so far in 2025 as in percentage terms? For Radhakishan Damani, it's Trent, which is down around 27 to 30 odd %. For Jhunjhunwala family, it's Style Bazaar, which they are the promoter of this company, and this company share prices are down around 30% so far in 2025. Followed by, for Mukur Agarwal, it's Raymond Lifestyle. For Akash Bhansali, it's Paytm, which is down around 20 to 30 odd % in 2025. Followed by, for Ashish Dhawan, it's AGI Greenpack. For Nimesha, it's Lakshmi Machine Work. For Madhusudan Kela, it's Neogen Fintech. Though this stock is not a big chunk of his portfolio, but this is down the most so far in 2025. For Ashish Kacholia, it's Zaggle Prepaid, and in fact this stock has seen a downtick of nearly 20 odd % in the last couple of days. For Sunil Singhania, it's IFL Securities, which is down the most in 2025, and for Vijay Kedia, it's Tejas Network, which has declined the most so far in 2025.
Okay, so interesting, and obviously, I mean, this is just to give you a sense that it's a tough market for everyone right now. But the Nifty has seen strong earnings per share and valuation correction as well from highs. So we're giving you every statistic and detail that you need around the big market fall. Anushi is joining in with more on this.
Hey, thanks for that, Tamanna. So now if you have to look at the Nifty key indices and the cuts therein and from the EPS highs which were there, and now what the estimates are, looking at some of the highest lows in the Nifty small cap 250 index, you're seeing EPS cuts of around 9 to 10%, 9.8% is the figure that we are looking at, followed by Nifty 50 and mid cap 150, which are clocking it about, which have seen about a 2 to 2.4% of a drag as well. Do consider that this is a culmination of various factors with stock specific earnings playing into the factor, global macros playing into the factor as well, and what is the certainty going forward for the business. Now if you are looking at the valuations and compare that to the EPS cuts that we are seeing, Nifty 50, if you are seeing this is on the basis of what the valuation at its peak was, what the current valuation is with the 1 year picture in mind. So 21 times was what the valuation was a few months ago at the highs, while now it currently stands and it has corrected to 19 times. Mid-cap 150 has seen the highest correction in terms of where the valuations are 36 times to 29 times, and small cap 250 seeing 26x to 22x. But what is interesting is some of the counters which have seen the steepest cuts in where the EPS is concerned. We have a list of stocks over here. First is Chennai Petroleum. This is the top one on the list with about 55% cut in their EPS estimates for the next 1 year onwards, followed by GMR Airports and Jubilant Pharmova seeing about 52 to 53% cuts as well. Kempla, Senmar, Westlife Foodward and Aster DM Healthcare are in the range of 45% to 50% of cuts as well. But what is interesting is despite these steep cuts that we are looking at, it's the valuations for some of the counters which have remained stabilized even at the current projections that are there. So the focus would also be on the trailing P rather than the forward P. Let's take Chennai Petroleum for example. Now the peak valuation was around 12 times, but current valuation stands at about 8 times. Jubilant Pharmova has not seen much of a difference, 36 times was the multiple 1 year forward multiple at its peak, which is now at 34 times, so not much of a difference that we are looking at. Kempla Senmar valuation remains unchanged at 37 times. Westlife Foodworld expensive valuation 188 times, but now it's come down to 165 times, and Aster DM Healthcare 59 times to 49 times. So a couple of these counters are very interesting. Watch out for, despite seeing such steep cuts in their estimates, valuations for some of these counters still remain expensive. So what could be the trajectory going forward is something that we should be watching out for, these 5 picks that are there in terms of where the top estimates are. So this is the overall view that we are looking at for Nifty 500 company universes.
Noted. Okay, Anushi, thanks so much for that. You know, it is at these times that you should speak to people who have seen multiple cycles, because tell you viewers, this has happened a number of times in the past. I was just telling somebody that while this seems painful, COVID was worse, and such cycles will get repeated often in an upcoming bull market. But the question to Sanjay Parekh, who's got oodles and oodles of experience, he's the founder and CEO of Som Asset Managers, but has served as a CIO and fund manager at multiple houses for a really long period of time, is how does this pain feel? Because Sanjay, thank you so much for taking the time out and speaking to us today. And we will talk about how you've modeled your current portfolio as well. But I want to talk to you about the cycle right now, right? Because for a lot of people, this is new. A lot of people who've come in post 2020, this is brand new, because yes, they have seen intermittent pain in the last 4 years, but this is that throbbing pain which is not even dull, and it seems like it's not going to go away. I'm getting countless messages asking me, when will this end? Now, you've seen various cycles like these, right, Sanjay? How does this feel?
Yeah, so, it's again back to equanimity, sanity, basic rules. We are back to basics. So earnings growth, valuation, they do matter all throughout. And we believe that at least in the larger caps, there have been earnings downgrade. You just, in the previous clip, your team explained that our earnings for larger caps, Nifty would be more like 1200, and then we move to 27, where it will be more like 1350. This year growth will be tepid. It's known Q1, Q2 was weak. Q3 will also be weak as we complete the session of the quarterly. But I think a lot of it is in the price now. So if you want to take a 15 to 18 month view, I think, and we've written that in our note also, that we think the price risk in the larger caps is gone. There could be a time risk. The near-term weakness, we believe, is led by dollar strengthening and the rupee weakness. RBI is doing a lot to defend rupee. And also the rupee that gets sucked out because of that, they're again pushing it in the through OMOs, which you saw yesterday of 2.5 lakh crores further infusion. Because part of it, when you defend rupee, you have to suck out the liquidity, which you are again giving it back. So the best part is now RBI stroke government clearly is aware that we need to, markets have to come back to, it's getting overdone is what I think. They also are aware, and that's coming through in actions earlier in budget and then now in monetary policy and the liquidity provision that they're doing. So I think it's a matter of time and we would bottom up very soon is what I think in Nifty. In the mid and small cap, it is going to be, because you have 6,000 stocks, So we believe that, again, the principles of growth at reasonable price, where valuations are reasonable, there are sanity, growth growth scale is not high. There you will see, some of it slowly bottoming out. Today, everything is with the same paint of brush. Everything is getting rogered. But slowly and steadily, sanity will prevail. And the stocks which are reasonably valued at reasonable growth will bounce back. But where there is froth in valuation and earnings are disappointing, because of over-ownership, you may see pain.
But Sanjay, I have a question, I have a fundamental question here. That yes, earnings are disappointing, but in some sense, this doesn't seem like a structural slowdown, right? Wherein for the next 4 quarters, earnings will likely be disappointing. Person after person, economist after economist is talking about how there was temporary liquidity tightness. There were 2 quarters wherein because of monsoon and because of elections, there was a pullback, which might reverse. Maybe we'll see some signs of that in Q4 and Q1, some more signs of that as well, right? So hopefully earnings will revive relative to what we've seen in Q2 and Q3, right? So my question therefore is, you've been at the forefront saying that large caps mein safety hai, mid caps, small caps mein nahi hai. Small caps are now down 21% from the peak.
Yes.
They are, yes, maybe expensive, but a lot less expensive than what they were.
Yes.
Is the froth near the close, or do you believe there is still a large correction left in small caps?
Yeah, so Neeraj, let's take, I'll not go get to a stock. Let's say one stock had an X earnings growth, 15 to 18%, but and the character of the business was great. It moved from 30 to 50 times. Now, when it moved from 30 to 15 times, and let's say the growth is 13 to 15%, and some disappointment happens. Now it's back to 30 times. Now, is that 30 times still cheap? I don't think so. Some of these EMS companies, I don't want to get into names because we don't own them, but they are still at 40, 50 times for growth where they're disappointed. And the management itself is telling them that my 2-year growth is going to be X. After that, they're 45 times after the fall. So I think somewhere where there is froth or the visible earnings are not there, we still have to be careful. Somewhere, let's say a mid-sized bank, a regional bank with good ROEs, doing 16% ROE, was at 0.8, it's gone to 0.7, it's actually done better, it's outperformed. It's a small cap stock. And will it go bad? I don't think so, So it will, but all of them have reacted, some of them at 10, some of them 20, some of them 40, some of them 60. So my point is that it will be back to earnings growth, reasonable valuation, and for sure the frothy valuation of 40, 50, 60 times, still there can be pain, is what I think, because there are a lot more there in those valuations today.
Okay, so the question, Sanjay, the question is this therefore, that let's assume that the pack at large, because of redemptions, because of otherwise, I mean, S. Narain's comments might have, set the cat amongst the pigeons. Maybe small cap funds are seeing redemption pressures, though Radhika Gupta was telling us that they haven't quite seen that per se. But let's assume that is happening at some AMCs and there is some withdrawal pressure, etc. There are some stocks, right, and a large number of stocks maybe, between the universe of 251 to 6,000.
Yes.
Where the valuations are not frothy, where the growth rates are decent.
Yes.
Now my question is, will they also get punished in the small cap carnage? Or do you think the market will now start differentiating between small caps and mid caps, which are showing promise of growth? Because a lot of new sectors are only there in the mid cap and the small cap space. They are unfortunately not there in the top 100.
Yeah, no, you're right. So Neeraj, I think, some of my senior colleagues are very, I work with them, I respect them a lot, but I think we can't paint all of them with the same brush. There will be a distinction between men and boys, and, quality at any price is certainly scary, according to me. You could have a great model, a great company doing great, certainly doing a great work around, but if the valuation is discomforting, you saw some of the best names in the e-commerce 30, 40% lower. So I think, it will always has been, which you started with looking at cycles, it's always back to basics of earnings growth, valuation, and reasonable valuation. And that we will see even in this cycle. So I think, there are pockets of reasonable valuation after the fall in small and mid caps. But all of them normally across cycles, when they fall, all of them fall. Some of them will fall 10%, 20%, some of them will 50, 60%. So, we all like, even in my funds, what mid cap, small caps I have, they also fell, right? I always feel they should not fall, but it doesn't happen that way. So I think now we'll come to, fundamentals, and the opportunity is there. I think you're right that there are various good businesses in small and mid caps, and we will have to hunt more, dig more, and get with a higher margin of safety. I think the margin of safety principle was forgotten in the rise, which will now come back.
Yeah, no, that's a fair point. And maybe the market texture now gives you the luxury to research properly and not necessarily buy the stock today because it's going to go up. You'll probably get time to buy. My question to you now, Sanjay, is this: what is the portfolio strategy that you adopted in your funds for you to deliver the performance? Because I think you've done really well, in these last 12 to 24 months. And are you changing that a little bit going ahead? Because it would have been prudent to be maybe even 100% large caps 6 months ago, right? Now that the falls have happened, what is the ideal portfolio construct, Sanjay, according to you, from now on for the next 12 months?
Yeah, so, our framework from day one, and when mid-cap, small-cap were rolling, our framework and mandate was, we'll have at least 70% large cap, at least.
Okay.
And in mid and small cap, we will go if we see that the price value divergence is high, and we spelled out that they should ideally double in 3 to 4 years. But beyond 4 years, it's almost like untouchable for us. So that discipline helped us over the last 2.5 years. We last 1.5 months back, we reduced small cap, got larger caps because they actually were very reasonable. And luckily, we were early to have reduced, but we still have small caps and mid caps. So today our positioning is 75% is large caps. We have around 5% cash, 5% plus mid caps, and the rest is small caps. And in mid caps, now IndusInd Bank is also classified as mid cap. So if we take that, we are at least at 79-80% into large cap. So we are fine. From here, we still feel larger caps, you have enough opportunities now. There are enough places where the valuations are really reasonable now. Not the entire Nifty, but at least 7, 8, 10 stocks where, or maybe more, which look really reasonable. You need to now do your shopping very well because a lot of them are attractive now. So that's where our focus will be. And in middle small cap, we'll be very selective. And if a threshold of the filtering criteria will further increase, and if we feel that there is some opportunity, we will actually do a bottom up there and be open to it.
Got it. Okay. Sanjay, I just wonder, because you are so connected in the market as well, have you heard from your cohorts of people who run the mutual funds that there are redemptions now starting to be seen in mid cap and small cap funds? Because we tried to do our channel checks. I think we've gotten equal measures of yes and a no, with more a no, that thus far it hasn't been seen. But I'm just trying to put 2 and 2 together, that as Naren speaks, there's some bit of fear around what could happen to mid cap, small cap funds. And the last 3-4 days, or 3 days at least, the small cap space has gotten butchered, literally butchered, right? Are you hearing from people that there are redemptions at the mid cap and small cap end?
Neeraj, actually, I'm also not totally well versed with what's happening because it's too short term if we're faced. But generally, I tell you the behavior of retail. If there are HNIs, in the funds, they may behave, or family offices, they may behave separately. But retail, by and large, after big falls, they pause. They don't rush up and panic sell. The behavior has been better. But I really would not know that if last 3-4 days there have been redemptions. But I genuinely believe that, SIP discontinuation, whether it'll happen or no, I'm not so clear how would they behave in mid and small caps on SIPs. I genuinely do.
Fair call. Sanjay, I really appreciate you taking the time out and joining us today. Thanks for taking the time out and giving us your thoughts. Really appreciate it.
My pleasure.
Right. And it's time like these wherein we really appreciate large money managers joining in. We were speaking to Sanjay Parekh. Absolute delight to get in Sunil Singhania, founder of Abacus Asset Managers. And Sunil, thank you. Really thank you for joining in today, because such an important day, because after a long time, there seems to be panic coming in from a lot of quarters when people are messaging me as well about this. How are you thinking about the current landscape, Sunil?
Good morning, Neeraj, and good morning to all your viewers. So I think markets have been challenging. There's absolutely no doubt about it. And as you rightly said, particularly the last 3-4 days have been, very scary when you see the screen. The Nifty is not indicating the full thing. The Nifty goes down by 1%, but the broader markets are down like on an index level 3%, on stock specific levels 8, 10, 15%. The breadth yesterday was maybe 95-1. Today it is even worse. And obviously it's been a combination of a lot of things. It obviously started with valuations, growth being a little bit slower, and so on and so forth. However, it's got a little bit amplified due to news flow which is coming, statements which are being made internationally related to tariffs and so on and so forth. Domestically, some statements have definitely caused some panic over the last 3-4 days. I think our view is that valuations were stretched. They have come off, quite a bit, but even now you don't have like hundreds of companies which you can go jump and buy. There is enough in terms of fair valuation, but it's not like completely cheap. Having said that, I think December numbers have been slightly better than September, and at least the indications for the current quarter, both on the economy side as well as corporate growth, seems to be, a little bit of reassuring. So in this kind of a scenario, as has been our experience in the past, it is best to just stay put, don't do anything, don't get swayed by short-term bounces and go overboard. Don't get scared by what is happening and sell at the wrong time. I think it is best to leave the markets on its own for the next maybe 6-7 days. Take a very, very measured and patient view and move forward. However, having said that, I think the indications which are coming from yesterday and today, and at least as far as my experience is concerned, of seeing these kind of markets, I'm starting to get a feeling that capitulation is very close, and this will, at least slow down or end pretty fast.
Okay. When Sunil Singhania says this, you got to listen. And Sunil, thank you for making that point. That's one key headline for me. I'm not going to take too much of your time, but I have 3 or 4 more pressing questions, Sunil, that I must ask you. One is the feeling, as you mentioned as well, globally some statements have been made. Yesterday we had Sridhar Shivram here who was saying that EM dedicated funds are seeing a lot of redemption. So it's not just India dedicated selling that is happening. And until that stems, FI outflows might well continue, and that might well continue putting pressure on markets, even if fundamentally markets reach valuations where there might be appetite to buy. Would that be a fair assessment? And what would your own thoughts be on this aspect?
So, last year was a tough year from a foreign inflow perspective. In fact, October was one of the worst months where we had almost 1 lakh crore selling by FIs, and it was predominantly, buy China, sell India, largely because of the valuation differential, as also the fact that China had announced a major stimulus. I think things were normalizing to some extent in November and December. However, January started with a lot of statements being made in terms of tariffs and so on and so forth. The dollar index from 101.2, which was there in September, jumped to 110. Currencies all over the world started to move quite, aggressively. And I think Indian rupee was no exception. And I think that sort of spoofed the global investors, and it was risk off completely. So there was a movement back into US because currency was strengthening, and there was generally a risk off, as I said earlier. And that's reflected in the outflows from emerging market funds and India funds who had received quite a decent inflow over the last 3-4 years have started to witness outflows also, because ultimately recency bias and recency performance does impact investors' behavior. Again, I don't know what will happen here, but this month has been very rough. On a daily basis, we are seeing almost $500 million of selling. But at some point, I think this has to stop. And I would say that we are nearing that sort of a phase. I don't know whether it will turn positive, but at least the intensity should slow down. The movement of rupee back to 86.9 yesterday and 86.7 today should be reassuring. And I think if global currencies stabilize, then there are more than enough funds who had missed India earlier who might use this opportunity and correction to build their positions. Because ultimately, there is no doubt that from a 5-7 years perspective, Indian economy continues to be one of the fastest growing economy. And I think Indian markets, therefore, should be one of the more interesting markets in the world.
Got it. Sunil, the fear has been around mid caps and small caps, as you alluded to as well, right? The Nifty is not giving the true picture. The broader markets are. Now, with the caveat, as you said, that let's leave the markets alone for the next 6-7 days, sit on the sidelines, wait and watch what happens. I'm inclined to ask this to you. A lot of high growth sectors, potentially high growth sectors, are not there in the Nifty 100. They might not be even there in the Nifty 150, if you will. Yeah, because there are a clutch of sectors that have gotten formed in the last 3-4 years. If valuations are attractive, but if the small cap space continues to see downticks, would you believe the good will get punished with the bad, or after a 20% correction in the small cap index, the market will learn to differentiate between the two?
So again, a few things. One is the Nifty has not fallen because there are quite a few stocks in the Nifty, like Asian Paints, Hindustan Lever, Nestle, Reliance, maybe an HDFC Bank, an ICICI Bank. Except maybe one like ICICI Bank, almost all these companies have done nothing for the last 3-4 years in terms of price performance. And therefore, in this year, they did not fall also because they had not moved up. And therefore, the Nifty to that extent has been very resilient because, 50-60% of the constituents who had not risen at all last 3-4 years have not fallen this 1 month. You can't say that Nifty has done very, very well. You have not invested for 1 month or 1.5 months.
True.
Having said that, I think you are right that there are quite a few stocks in the mid and small caps, which are new age companies which don't have profitability or low profit, and which had a lot of hope built in, and the price went up 3-4x, and maybe all the IPOs which came in are a part of the mid or small cap indices, and they came at significantly higher valuations because of all the huge promises which were made during the IPO process, and they have also fallen. So in the mid and small cap, you will have to be more stock specific. For example, we invest only in profit making companies, so for us these companies don't exist. But from an investor perspective, I don't think the indices are going to give you the best sort of conclusion. Because a small cap index might comprise of 300-400 companies. Some of them might not have profits at all, and therefore the P multiple also gets a little bit of it's not the fair estimation, because the P looks like 30, but there are maybe 20-25% companies which are in losses, which sort of complicate the whole process. So mid and small cap is more about stock specific. Having said that, I would still advise, being a proponent of mid and small cap all my life, I would still advise at this point of time to have a balanced approach, because this choppiness might continue for some time. We are looking at market stabilizing, but we don't see a V-shaped recovery. At best, it would be an upward moving W-shaped recovery.
Got it. Sunil, a lot of high growth pockets are being singled out in commentary, maybe on the markets as well, but in commentary. EMS has become the poster boy of making an example of how companies were overvalued. My question to you is this, that a lot of these companies are, even in the recently concluded quarter, giving some very high growth promises, right? And the managements are on record saying that we'll probably grow 40, 50, 60% or what have you. Now my question, would these companies continue to get punished if they indeed show growth? EMS is one, the green energies exposed companies are others, or do you think the markets will start rewarding growth once the dust settles in the small cap space?
So Neeraj, markets obviously, respect fundamentals. But market price is equal to EPS into PE, and EPS is the profits, the PE is the perception. And perceptions change for a variety of reasons. New themes normally get a higher valuation because of the perception of higher growth and so on and so forth. So some of the themes and sectors you mentioned have great future, no doubt about it. At the same time, I think it's some of the companies which are listed got the advantage because there were not too many companies listed in that particular segment. So investors who are positive on that segment had very few choices, and therefore the listed companies got the benefit of scarcity. As we speak, more and more companies in all these high growth spaces are getting listed because equity markets have been kind. Businesses have been able to raise capital and grow quite rapidly, and that also creates, competition. But if the company keeps on growing at 50-60% for 2-3 years, and valuations have contracted at 30-40%, then at some point of time they will become very great buys, because if you are able to get some companies which over a period of 5-7 years can grow at 20% plus at maybe 25-30 P, it makes tremendous sense. So market will take care of excesses as well as excesses on the downside. I think that has been the trend. No one is superior than the markets. Markets will normalize. From time to time, markets go into these phases of overvaluations, exuberance, and then low valuation, and then just panic. I don't think we have reached a scale of panic as far as valuation is concerned, but in terms of market mood and the intensity of the fall, we are somewhere closer. But markets will adjust on its own. And if these companies keep on growing at 40-50%, then there is definitely going to be a lot of interest in these companies.
Sunil, I have one last question if you have the time, but just one last question. And that is on private markets, because they have become a very large part of almost every investor's book, right? I'm just trying to understand. They got a big fillip because of the kind of gains people made in public markets. I'm wondering if that space sees a significant cool off as well because of what's happening in the public markets, or could the template out there be different?
Neeraj, I would really, stick my neck out and say that market is going to give the maximum pain. Particularly what has happened over the last 1.5 years, there was so much capital available and there was such a huge FOMO. Any company with a presentation was able to paint great future and raise capital left, right, and center. And I think that went in a lot in private markets. We also launched a private market fund, mid to late stage. Luckily, we follow a disciplined approach where we are value conscious and we don't invest in loss-making companies. And we had drawn down 20% of the corpus of 2,400 crores we raised, out of which we have invested around 75-80%, but in good value companies. So we are quite, sure that in the next 6-8 months, we will get great opportunity. Because one, the propensity and the eagerness to invest in private market will go down significantly. A lot of investment, as I said, which has gone into private markets in the last 6 to 12 months is going to give a lot of pain, particularly to large high net worth individuals and family offices who had high risk appetite and therefore the due diligence process shortened. I jokingly say that in bull markets, the time to research reduces and the bet size increases. And in bear markets, the time to research increases and the bet size reduces. So last year was a time when the time to research was 2 hours and the bet size was 50-100 crores for each investor. The company used to come and say, "But dalna hai to dalo, nahi to isne dala hai, usne dala hai, isne dala hai, aapko dalna hai to dalo." There was this FOMO. So I think over the next 6-8 months, 12 months, that segment will again give opportunity. Right. But I would say that what money has been raised last 6-12 months is going to give a lot of pain.
Got it. Yeah, fair point. Maybe researchers or fund managers, it might be a good time because there will be enough time to choose and pick where you want to invest as opposed to it being running out. But
I'll just end. No one likes bear markets and it is very painful. But I think in a cycle of markets, and we have seen that over the last 25-30 years, sometimes these kind of pains come, and it's very easy to say that बेच देना चाहिए था, फिर ले लेते थे. That doesn't happen. And frankly, it is very tax efficient. So, say if our funds have gone down by 10-12%, even if you would have sold and bought it back, that much money would have lost in taxation. Yeah, and then, entry point, exit point, impact cost, and so on and so forth. So these things happen. I think it is best to be a little bit patient. I know it is very tough, and particularly for people like us who manage public money. And I really, sympathize with the investors and RMs, and therefore we are doing a lot of calls also, because this is a time to handhold and give, fair advice. But please stay put. Don't try to do anything exotic. You might defer your investment. That is fine. But just don't sell because you are scared. You can adjust your asset allocation. If you're significantly overweight even now, maybe you can adjust a little bit. But don't get scared and do something which would amplify the already pain which we are all undergoing.
We started with the short-term advice from Sunil Singhania. Let the next 6-7 days go, be patient. And we're ending with a long-term advice from Sunil Singhania. Sunil, so important to have you on a day like this. Thanks for your time.
Thank you.
Right, that's a very large market voice with his words of wisdom. We wrap it up on this leg of India Market Open on the news that maybe, just maybe, there's a faint tick of an uptick from the lows of the day. Let's see if that lasts or no. Thanks for tuning in.
new tax regime for individual. In fact, there has been discussion on how to sort of reduce the tax rate.
I am now happy to announce that there will be no income tax payable up to income of 12 lakh rupees.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Government is considering to increase the custom duty on the imported finished goods ranging from consumer electronics to medical devices.
And to rectify inverted duty structure, I propose to increase the BCD on interactive flat panel display from 10% to 20%.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers.
Welcome back. You're watching Ask Profit. Canterville Retail is in focus on the back of its Q3 earnings. Good set of numbers, being the festive season and of course winter season as well. Revenue is up 27%, EBITDA up 33%. Margins have improved to 33%, and net profit up by around 42%. And to discuss as to how the quarter has gone by and how things are shaping up for the company, we are joined by Shivendra Nigam, who is the CFO of Canterville Retail, who is joining us now. Welcome to the show, Mr. Nigam. My first question to you is: it's been a great quarter overall for Canterville Retail Limited. I wanted to understand as to what has augured this kind of growth, because rural is picking up, which is why tier 2, tier 3 cities are seeing more demand. And of course, with respect to the winter portfolio also, you might have seen a good uptick. What's the reading like?
So thank you. Thanks for calling. Yes, mainly due to wedding season and extended wedding season, the things were good. But overall brand was due to, getting this kind of momentum. So first half was slightly on a flatter side. So overall demand in all the, whether it's a tier 1 city, tier 2 city or tier 3, all picked up. We have registered a record sales, same store sales growth of 17+%, right? So for the quarter, first time we also did 200 crore in the quarter itself, first time. So overall demand in the market was set, and it has been done in a tremendous way. And wedding was one of the reasons for this.
Right, Mr. Nigam, your margins have significantly improved to 33%, which has not been the case before, right? They've been in the range of around 25 to 30 odd percent. Do you think that 33% of margins are sustainable going forward as well?
So important is seeing how the margin trends quarter on quarter is being shaping up. So for us, Q3 was always high and it has always been delivering 30 plus of the margins, right? Because as I earlier said also, the costs are fixed in nature. Rentals are fixed, salaries are fixed. The moment I'll get the better same store sales growth, EBITDA margin is definitely improved because directly the gross margin has been converted into EBITDA margin. And we have made more robust our gross margin as well. It is 1% up, 61% as compared to 60%. So yes, overall my EBITDA margin has been improved, and as for the earlier guidance as well, we have been able to achieve approximately, will be better off from the last year, and the standard 28 to 30% EBITDA margin is still going to be achieved.
Shivendra, the next question is related to that. Alex joining in. You said that you intend to increase the store count to 700 plus. If I understand correctly, it's about 550 right now. Correct me if I'm wrong.
576.
576. And most of them are owned stores, right? So 400 plus are owned stores. Can you help me understand, once you achieve this entire breakup, what will the breakup of FOCO versus company owned be, and what will the implication to your margins be from that perspective? Because as I understand it, the company owned stores will give you better margins, right?
So yes, out of this, my December numbers are 576 stores, and we are working expanding on the same guidance of 70 to 80 stores per year. So this year also will be ended up with the same guidance, and 600 plus would be the closing number. Out of this, for 133 are the franchisee owned, and the company owned is the balance, approximately 443. These are the stores. Yes, expansion now is going majorly 90% plus in on the company owned stores only, because we are opening the bigger store size now. And my 9 months average size is 1700 plus. Average company size is approximately 1300. My average size opening for the last 9 months is 1700 plus, right? So going forward also, this ratio is going to be maintained. Majority stores will be the company owned stores, bigger in size, and few franchisee stores would come up. And yes, the margin is going to be intact because the company owned is having slightly on a better margin, and mainly we are opening the bigger stores because we are having increasing the portfolio as well. Ladies are there, kids are doing goods. We have accessories contribution is good. Men's is obviously there. So now it's the requirement of the bigger store. So where we are getting approximately 1000 square feet of store, the men's store, and the bigger 1500 plus stores are the family stores only. So going forward, also this size to be maintained mainly on the COCO side.
Okay. So. Point well taken. Shivendra, the next question is also related to this expansion and the network at the end of 2 years, right? So if you're going to have over 700 stores, and if the intention is to increase your reach in tier 2 cities and tier 3 cities, what will this split be between that? And are these larger stores that you're opening, are they focused in urban centers or in the broader markets?
All the markets, to be honest, all the markets, right? So going with as of now, tier 1 is mainly counting the 8 big cities. So we are in South India, we are not there, right? So there are restrictions in tier 1. So we are mostly expanding in tier 2 and tier 3 markets. So bigger stores are opening in tier 2 and tier 3 market as well. So going forward, the same plan we are opening tier 1 wherever availability is there. Like we are in Delhi. To Delhi already we are having 55 plus stores. NCR we are having 90 plus stores. But the opportunities comes, we opened couple of stores in Delhi itself. Mumbai we are been expanding. So wherever in these big cities, tier 1 availability is there, we are opening, but the majority of the expansion going forward in tier 2 and tier 3 cities. And yes, you rightly said, by the FY27, we are supposed to cross 700 plus stores, and 1000 crore of revenue would have been there.
Right. Mr. Nigam, with respect to the kind of robust growth that you're kind of penciling in, FY24 you've done over 615 crores of revenue top line. This 9 months FY25 you're already done over 500 odd crores. What's the target like for FY25 and FY26 as well? Because we have been given a boost in consumption through no taxes being paid till 12 lakh rupees. What's the kind of growth that you're penciling in terms of top line as well as bottom line?
Right. So we targeting 18 to 20% is the growth, 17, 18, 19% would the continuous growth going forward as well with the part of this expansion, out of which it is important to have a same store sales growth. So 5 to 6% is the same store sales growth, and overall target, we are targeting 18 to 20%. Yes, you rightly said it's a big boost for the consumption is 1 lakh crore plus directly given to the hand. Then RBI cut the rate cut. So this is the consumption is going, and ultimately is going to help the retailers only. So we are very hopeful. Our target of 18 to 20% are going to achieve. So this year, as you said, at approximately 18 to 20%, somewhere around from 617, 725 to 730, we are finishing this year, and then next year also, and going forward in next 2 years with this rate, 1,000 crore plus by FY27 should achieve.
And point well made. And also you're also guiding to retain your margins. Shivendra, pleasure speaking with you, and I look forward to the next update and speaking to you soon. Thank you so much for taking the time.
Thank you. Thanks a lot. Thank you so much.
All right, let's go back to the questions. And we've got some interesting ones that are lined up as well. I believe we've got a caller. Raj is calling us from Bengaluru. Raj, hi, good morning, and thanks so much for waiting by. What's your question?
Yeah, hi Alex, good morning, and NDTV team, good morning, and hi everybody, good morning.
Good morning.
See, I was holding Windlass Biotech at the rate 800, and see, I would like to know, the results were fine yesterday, and top line growth was good, but bottom line I could find that it is around 3%, that is actually the growth. However, results were good, as it is a small cap. I would, all the small caps are actually, even after giving good results, even the larger ones are falling. So it is the same case with this also. I would like to know, as this is in CDMO space, can I hold it, or can I buy more? Should I wait more, or should I just exit out of this? Both, the fundamental and the technical.
So I can choose one, but Raj, since you're holding this for the long term, I'm just asking. You've got a pretty small holding, 20 shares. Are you planning to build it over a period of time? Was that the original thought, was to build it over a period of time?
Yes.
Okay. So Rajesh, then from that perspective, the question is to you. He's got 20 shares and he's in the green. The CDMO space, interestingly, a lot of players have reported better numbers and the outlook is relatively positive, right? So would you say that this is the best play? Would you suggest that he can increase his holding over the next few months?
See, Alex, there are two things. One, the gentleman has done a thorough research, and the second one is he's lucky in this market. Setting in a profit on a small cap company is a lucky thing, I would say. Yes, the CDMO space is doing well. There are positive reviews coming in from management commentaries and all those things. But Windlass, I think at this point of time, is a very small cap company to play on a CDMO thing for a longer term horizon. Maybe a Laurus Lab or the other companies, maybe a better bet. So I would say you're sitting on a profit, switch from here to a Laurus Lab.
All right. So that's the view coming in on the entire CDMO space, in fact. The next query that we have is from Kushai Guda. His query is on Tata Motors. He's holding 305 shares bought at 874 a piece. So he's sitting on a loss of roughly 58,000 rupees right now. He wants to know whether he should keep holding it or sell at the current levels. Vaishali, I'll come to you on this one. On the charts, Tata Motors, what's the outlook like? Vaishali, I think you're on mute.
So I think Tata Motors have seen deep erosion, and I think, yes, am I audible now? Am I audible now?
Yes, you are. You're audible now, Vaishali. Okay, I think we've lost her due to technical issue. Rajesh, I'll come to you then. Tata Motors, what's the view like?
See, the company is good, no doubt on that. EV space is doing well. The numbers have been good, or monthly optic numbers. But still, I think somehow the valuation at this point in time is far more higher than the other companies of the peer set. Maybe a Hyundai Motor or a Bajaj Auto are on a better footing than what Tata Motors is at this point of time. Long term, yes, it's very good. Maybe one can continue to hold for a period of 2 to 3 years. But on valuation perspective, I think Hyundai is far more better than what Tata Motors is.
Right, Hyundai better than Tata Motors, the view coming in, but from a longer term perspective, you can continue to hold is the view for Tata Motors. The next query that we have is a caller, Samish from Chennai is calling in. Samish, a very good morning to you. How can we help you?
Hi, good morning.
Good morning.
So, I'm holding Suzlon Energy shares around like 214, averaging it around 44.12, I guess. So it's like I'm just started accumulating this share since it was around like 37, and recently it went up like it hit like upper circuits for 2 to 3 sessions, I guess. So like after that it's still falling even though the result is good. So I'm just thinking like to down average it from current valuation. So is it wise to down average the same, or like can I sell the stock now and just try to buy it after some time, like?
All right.
Again, if you bottom it out.
All right. Rajesh, again, I'll come to you. Suzlon Energy is the counter. I mean, the downtick in the stock is probably because of the entire market sentiment going down. But do you think that exiting right now and then making entry at the right levels makes sense for Suzlon Energy?
See, for a long-term investor, I don't think this would be a good strategy, selling now and buying again after it goes down, because one, the taxes take your differential profit which you make. Secondly, you never know tomorrow again you sell a stock and tomorrow it starts moving up. So no point in doing that. But as far as Suzlon is concerned, I think all the positives has been discounted. They have almost reduced, come to zero debt, I would say. Capacity is good, but the entire positives has been discounted in the price. It has run up quite a lot in the last 2-3 years or so. It's time to get out of this and maybe switch to a Tata Power, which is more stable in a renewable energy space, where you can at least be assured of your stability of your investment. So move from Suzlon to Tata.
So the two things to watch out for, of course, are your tax implications and, of course, the transaction cost. In certain situations, and consult your advisor, it might actually make sense for you to book losses to set off any gains that you might have in the rest of your portfolio. Rajesh, I don't know if you ascribe to that strategy at all, but if you've got over exposure to certain pockets of the market that are seeing a deterioration, perhaps it's something to consider. KNR Construction, the next counter that we're talking about. Rohan from Telangana is asking about this. He's bought at a price of 333 rupees per share and he's seeing losses. 263 is the current market price. What are the prospects? Should he add more right now, Rajesh?
No, adding at this point of time is not recommended, but yes, one can continue to hold, let the market stabilize and try to get out an optics. There are better opportunities in the construction space. Maybe Larsen would be the best, I would say, no doubt on that. But even IRB Infra or JK Infra would be a better bet.
All right. The next query that we have is from Amit, who's from Gurgaon. He's holding 500 shares of Nippon AMC at 685 a piece. He wants to know whether he should buy the dip or exit at the current levels. Rajesh, your view on the counter?
See, the entire AMC space is saying some amount of profit booking because two things. One, they have run up quite a lot in the last 1 year or so. Second, as we all know, equity markets in a wobbly situation at this point of time. So they are facing the heat. But long-term prospects looks very good. One. And when you compare Nippon Life with the other AMC companies, you find the valuations are still very attractive when you compare to other names. So it's better to stick to this, continue for long term.
Okay, continue for the long term. Yatin, actually, no, that's a slightly long term question, so I'm going to take that later. But the question from Venkat is an interesting one. Would you hold on to an investment in Finiotex Chemicals? The stock is holding on, it's not doing too much in trade from what I can say. Pull up Finiotex Chemicals. It's actually a manufacturer of auxiliaries and specialty chemicals for textiles. 3,200 odd crore market capitalization, bought at levels of 62 rupees 3 years back. On the longer term charts, Vaishali, what would you do with this?
So I would say actually most of the chemical stocks have not done well, but I think it's a cycle. And seeing the Finiotex Chemical, it is quite at bottom. I mean, the long-term trend is intact, and I think right now I would say continue holding with a stop loss of 265 because this would give a good return once this sector starts moving up.
All right, so that's the view coming in on Finiotex Chemicals, right? The next query that we have is from a caller, Puran Chandra, if I'm not wrong, is his name, from Hyderabad, is calling in. A very good morning to you. How can we help you?
Yeah, very good morning. Myself, Purna Chandra. Good morning to all.
Good morning.
Actually, I have invested in Akums Pharma.
Okay.
After the IPO, the share has corrected.
Okay.
And there was a good participation from anchors. And this has a 30% of CDMO market share. And retention rate of pharma companies is good in this company. So this is the reason why I have invested after a bit correction. So, is this the right time during the correction if I can add something more in this, or do I have to wait for some more time? Actually, I am planning to add some more after a correction of 10% or so.
Understood. Understood.
And we don't have PE, we don't have EV EBITDA also for this company, as this is a newly incumbent.
Got it.
Price to share is good valuation.
Understood, understood. Rajesh, your view on Akums Pharma?
It's a very strong company, a good play on CDMO, recently listed. The only thing is you have bought at 561, it's trading at 549. So at least wait for 10-15% cut if it happens. For averaging, at this point of time, averaging doesn't make any sense. For a long term, yes, one can continue to hold.
Okay, from what I can see, the trailing price to earnings is around 60 times. And yeah, it's okay, it's an interesting stock to look at. Yatin Desai is writing in. He's 60 years old, he points out, and he's from Mumbai, and he's got a query about the prospects of the Bazaar Style. Let's pull this up, Bazaar Style, and I mean, I'm not able to pull up the counter, but okay, Bazaar Style, he's seeing a loss. He's bought at levels of 320, and the stock is under pressure in trade today. He's asking what the prospects are for the next 3 to 5 years. Should he hold or sell? Rajesh, on the fundamentals, do you have a view on this one, and would you hold?
See, if I have to hold, I won't hold for a long-term horizon because the margins are very low. It's in a low ticket size retail marketing. Yes, it's growing too well, adding more stores, but at this point of time, I won't add, neither I would sell because of market condition. It's fallen very much. Around 250, 260 levels, I would try to exit.
All right, exit is the view coming in for Bazaar Style. The next caller that we have is Bhanu Chandran, who's calling in from Telangana. Very good morning to you. I believe you have a query on Rajesh Exports. Hi, we can hear you. Yes, I can hear you. Go ahead with your query.
I bought Rajesh Export at 549 rupees. I have 750 shares.
Okay.
At present situation, can I hold it or sell?
Okay, I'll get your technical view on this one. Vaishali, your view on Rajesh Exports with respect to the charts. Q3 was pretty strong for the company, considering the wedding season. But on the charts, how does it fare?
So I think it is worth holding because overall market has gone into a corrective mode, but compared to that, I mean, this is still okay. I would say continue holding, wait for a bounce, wait for a good time, and then we can have a relook.
Okay, it has given up quite considerable ground from when Bhanuchandran bought. Rajesh, quick view on this one. If you have a view, bought at very elevated levels. So what should he do?
It's a sell from our side. There are a lot of issues, diamond exports and all that. I don't think one should continue for a long-term portfolio. Maybe trading opportunities are in there. On a fundamental view, it's an exit.
It's an exit, okay, because it's had a torrid time over the last 6 months or so, down over 40%. HAL is a counter that is under pressure today. Let's pull up Hindustan Aeronautics, and this is on account of comments that were made by the top officer of the armed forces, and talking about the delivery schedule of HAL, and the stock took a bit of a battering. You can't say whether that was the reason or it's just the texture of the market that caused the pressure on the downside. But we've got Gul, who's bought at levels of 4,221, slightly elevated level. But would you add more at the current price, and what is the strategy that you would employ based on the current charts? Vaishali, on the charts, what should his strategy be?
So I would say yes, I do agree that the stock has got into a corrective mode, but when I'm looking at the weekly chart and all that, the trend is still okay. It is just a regular retracement. So and it's really difficult to have the bottomed out stocks, but I think there is scope for further downside also if market is to correct further. I think 3200 is a level to watch. 3200 is a very good support level. I think he can average out at those levels.
Okay. All right. What you just saw on your screen, of course, was the comments that were made by the Air Chief Marshal. There is a clarification as well, and we'll get you over the course of the day. It's now time to hit the rapid fire segment, and this is Vaishali and Rajesh, where we throw questions at you over the course of the next 2 minutes. Do answer as briefly and concisely as possible. The first question to Rajesh. We've got Nagula Raju who's asking about Tata Technologies, which he's got an allotment in IPO. Should he hold for the long term is a question. Rajesh?
It's an ad from our side.
Correct. Phenolix Industries is the next counter. Sunil from Andhra Pradesh wants to know whether they should hold, average out or sell at the current levels. Vaishali, on the charts?
Hold.
Okay, CDSL, fundamental views being short. Rajan has bought at levels of 1,410. Should he add more at this juncture or would you wait? Rajesh?
Of course, one can add. Corrected quite a lot. Good company add.
All right. India Cements is the next counter. Priyanka from Jaipur is holding 1,000 shares, bought at 375 a piece. Can she wait for 1 year or add more at the current levels? Rajesh, your view?
You can continue to hold, no adding.
Okay. Coming back to you, Rajesh, Zomato, bought at levels of 238. This is Purna Sai, 127 shares. Looking at the long-term prospects, what would you do?
It's a sell from a side.
All right.
Numbers have been not that good.
Right. RBNL is the next counter. Yogesh wants to know the support and resistance levels for this counter. Vaishali, on the charts?
Well, RBNL is corrected quite a bit, and I would say hold on. The support, near-term support comes at 340,
Okay.
and resistance is at 3.
Okay. GE Shipping, coming back to you, Vaishali, on this one, bought at levels of 1,160 a piece. Would you book losses and exit and buy something else?
I don't think so. Shipping is not going to go out of fashion, so hold.
Okay.
All right. Prince Pipes is the next counter. Debe and Tiwari is asking this question whether to hold, exit or buy. Rajesh, on the your view on Prince Pipes?
2-3 days back, numbers came. They were not that good. Margins were under pressure. It's exit.
Okay. Last question. Siemens, ABB, Cummins. Which one would you buy for the medium to long term, Rajesh?
Difficult one. All three are good buys. But if you have to choose one, Siemens.
Siemens. All right. Thank you so much, Vaishali, Rajesh, for joining us on this program. And we had to interrupt you and keep you waiting for many of the minutes that we spent with you. So thank you for your patience. Appreciate it. All right, that brings us to the end of this edition of Ask Profit. It's been a pleasure bringing it to you. And if your specific question was not answered, we'll be back tomorrow to take more questions. In the meanwhile, do stay tuned. It's a goodbye from Mahima and myself and the team that put this show together. Thank you so much for watching.
entire special package and measures are kind of focus on AI skilling and how to sort of facilitate the AI centers which is existing at this point of time.
Now a center of excellence in artificial intelligence for education will be set up with a total outlay of 500 crores.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Sources telling us is that government is expected to provide a roadmap of the next phase of national monetization pipeline, where they are going to set a higher target for the next fiscal onwards.
Building on the success of the first asset monetization plan announced in 2021, the second plan for 2025 to 30 will be launched to plow back capital of 10 lakh crore in new projects.
Hello and welcome to KYC, a show designed to give regular investors powerful, actionable insights into the fundamentals of a single NSE-listed company every single day. We have yet another interesting company on the spotlight today, and that's BLS International. Of course, BLS International also has another subsidiary which is listed, that is BLS E-Services, but today we're going to talk about the parent, the larger one, with a market capitalization of around 16,000 crores at the moment. Let me start by telling you about what this company is all about. Now, it's a tech-enabled services player. What services does it provide? Well, it essentially provides services around the visa, passport, consular, citizenship, e-governance, attestation, biometric, services, with all the governments that it is associated with all the various governments across the world it has partnered with. And among them, well, as I mentioned, that these are a handful of aspects that the company does cater to. This is actually a 4-decade-old company. It's listed, of course, some time ago, but it does have a global presence, and because of the fact that it has a diversified list of services at the moment, it's in fact one of the bigger, visa application outsourcing players in not just in India but also the world. It of course does offer a handful of advantages. If you just move on and talk about the corporate structure as well, besides its core focus, it also has about 100% holding in the BLS International FZE, about 51% in SLW Sports Media, and of course BLS E-Services, where it also holds around 51% stake as a promoter. And well, we do also know that BLS E-Services is also listed on the Indian exchanges. Now, this is as far as what BLS International does. Largely catering to the services around visa applications and e-governance and several other factors. But what we usually tend to do on this show is we take every company and will assess it based on the kind of performance that has come through, not just in terms of the revenues and balance sheet, but also cash flows. And after these financial statements, we also take a look at the return ratios. Moving on, we also consider how the shareholding has been, the kind of impact the shareholding can have on, a certain premium for the stock, street credentials in terms of the returns that the stock has seen, valuations, as well as street coverage. And to take us through some of these aspects, I am joined by my colleague Mahima, who's also going to shed some more light with respect to BLS International and how things have potentially panned out. So Mahima, thanks for joining in. As usual, let's start by taking a look at how the top line and the bottom line has panned out for the company over the past few years.
Right. So, strong set of numbers in terms of if we, check the 3-year CAGR for the company. In terms of 9 months FY25, the revenue stood at 1,500 odd crore rupees, and the 3-year CAGR for revenue has been 43%. EBITDA CAGR has been 98%, and net profit CAGR has been 80%. Margins have also improved, overall for the company. In terms of the revenue breakup, 2 main services provided by the company are being broken down into 2 segments, that is visa and consular services and the digital services. FY24 visa and consular services was around 81% of the total revenue, and digital services was around 19% of the total revenue. In terms of 9 months FY25, key operational metrics with respect to the numbers, in terms of visa and consular services, the number of applications grew by around 29% YOY, and net revenue per application grew by 38%, which is why we've seen a significant uptick in the top line number overall in 9 months FY25.
So that's coming down to how the revenues are panning out, and does seem like based, even judging by the 9-month revenues, it does seem like the company has been able to hold on to its growth. Let's talk about the balance sheet then, and it's a curious case. So we were actually a little bit on the fence of whether or not we should give the balance sheet a neutral rating or a thumbs up rating. And at the moment, what we are witnessing and what we are noticing is that the company has a very strong net worth of around 1,400 crores, and it has only improved over time. However, there has been an increase in gross debt. As in there has been an addition in gross debt. Now, we are yet to figure out whether or not this gross debt eventually gets subsumed by the end of this particular financial year, because before this, there was no gross debt at all. The company does have a very strong balance sheet case in this case, and that's something that we need to keep an eye on. The cash and bank specifically, that of course always augurs well. So it always works in favor of not just your flows, but also in terms of the kind of impact that it can potentially have for your cash flows too. So but because of the fact that there has been a little bit of an increase in your gross debt, is the reason why we're going to give it a neutral rating and not necessarily a thumbs up. So that's how things are. But I'm sure that Mahima will tell you that the cash flows also look pretty good.
Absolutely. So, while we've given neutral to the balance sheet just because the debt has gone up, cash flows certainly is a thumbs up for the company. In terms of cash flow from operations, if we see the FY24 number, it stood at 350 crores, which is just, almost the same as in the first half of FY25. So, they've done, cash flow from operations in the half year, which they did in full year last year. So, big thumbs up on the back of that. And net cash flow has also significantly gone up from 281 crores to 347 crore. So, and the kind of business that they are into is a, highly liquid business as well, which is why, the cash flow for the company is pretty much strong. So we've given a thumbs up when it comes to the cash flow, Agam.
Okay, so a thumbs up for cash flows as well, and well, that brings us to the end of assessing of the financial statements, and based on that, what kind of return ratios are you looking at? Well, as one might expect, very strong indeed. So when it comes to your return on equity, the ideal number would be mark well over 20%. The company is actually looking at an improvement from around 19.5% for return on equity all the way to nearly 27% by the end of 2024. It's the same for capital employed. These ratios have also improved drastically from 22%, ROCE, all the way to nearly 29% at the end of 2024. And well, it does seem like the fact that the company is on a very strong growth path with the kind of cash it generates and the returns it has on an operational level, well, it's only natural that the return ratios will also be so strong. So in general, all these factors come into play and in favor of BLS International, which is why it's going to be a thumbs up here as well. But as we move on, let's talk about the shareholding pattern as well. And it does seem like it's a well-held company, Mahima.
Absolutely. I mean, promoter holding at 70% is definitely a well-held company, as you rightly mentioned. In terms of the holding versus December 24 versus September 24, promoters holding has not changed. DI holdings, has slid a tad bit, but FII holdings has increased from 9% to 11%, and overall public holding has gone down by a bit, which was around 18.9% in September 24, which has come to 17.2% in December 24. Now, in terms of the holding overall, from a longer term perspective, promoter stake has reduced from around 74.6% to 70.4%, but still 70% holding from promoters is definitely a well-held company, as Agam rightly mentioned. FI stake increased from 1.4% to 11%. 1.4 was in March 22, and in December 24 it was at 11%. Public share has, however, decreased from 24% in March 22 to around 17.2% in December 24. So public shareholding has been going down, but FI has overall increased, and promoter stake has remained stable overall. Agam, so we've given a thumbs up in terms of shareholding pattern.
Yep, absolutely. So that's as far as your shareholding pattern goes. I'm going to talk about street credentials. And, this is where we were on the fence as to how we should go about rating the company based on the kind of returns it has seen and shown. So, firstly, if you just zoom out and take a look at the returns that is shown over the last 5 years, it's a massive multi-bagger. It's given you 31 times the returns over the last 5 years. If you consider the last 1 year, and we do know that the last 4 months, particularly in the last 12 months, have been extremely challenging, which is why it's given you a return of around 10%. Now, at 16,000 crores of market cap, BLS International would likely be classified under the AMFI rules as a small cap. So if you consider the small cap index and the kind of returns it has given in the last 12 months, that's a decline of 3%. So BLS International is up 10% against the small cap index, declining by around 3%. Mind you that even the Nifty 50 is only up by around 3.5%, 4% over the last 12 months. So BLS International has certainly outperformed not only its peer index, but also the benchmark index, and which is why over the last 1 year, we're going to give this one a thumbs up too. And finally, moving down to valuations, naturally, Mahima, if everything is going to look good, then please tell us about the valuation.
Sure. So this is the only counter that we've given thumbs down to. Otherwise, it was either neutral or thumbs up, because the valuation picture still does not. Because we've seen such a run up in the stock price, the valuation picture does not paint a very pretty picture in terms of 12 months trailing. And this is despite of the kind of downtick that the markets have seen and even the stock has seen. 12 months trailing PE stands around 52.7 times, and as per Bloomberg, if we go to 2025 estimates, it stands at around 33.4 times, and 2026 it goes down to around 25 times. 25 times by FY26 still does not look cheap, which is why this is the only counter that we've given a thumbs down to, because valuations for this company are not going to get cheap even in the next 2 years.
So, to be fair, what usually happens is for companies which have shown such strong growth, we usually don't tend to see as much correction from the top as compared to, say, the mid-cap or the small-cap index. And that is the case for BLS International, which is why it's a relative outperformer. Well, fundamentally in a strong place right now, and naturally doing well as compared to other, mid-cap and small-cap companies in this case. And which is why, that brings us to the final parameter here. And that's what the street is making of it. Unfortunately, at least the consensus and the Bloomberg consensus, it only has one analyst who has coverage on this particular counter, and that is indicating an upside of around 51% from current market levels. But because of the fact we don't have a lot of analysts, at least on the Bloomberg consensus covering this, we're gonna not give this a rating, and we're gonna stay with the neutral form. So that actually brings us to a total roundup of how things have panned out for BLS International. So when it comes to its revenue and in the income statement in general, your profitability, your balance sheet, your cash flows, all in a very, very good place. Even the balance sheet actually looks very, very strong. Don't get me wrong there. Return ratios as well, a big thumbs up. So at least as far as the financial statements are concerned over the past few years, it's come up with the goods. Well, shareholding again strong, very well held company with the promoters as well as institutions. And well, we do know the kind of returns that the company has seen. It's just the valuations which are a bit of a concern, especially in a market climate like this. It continues to be a little bit of a factor that we're worried, which comes down to, well, a 6 out of 8 rating for BLS International, and that's of course a 75%, so it's first class with distinction under many circumstances. We do have the management with us, but before we go to the management, let's very quickly address the SWOT analysis for the company as well. I'm going to talk about the strengths. So firstly, the only listed player with a strong base. It has about 41,500 business correspondents across India, well over 130,000 touch points, and it has a span of around 70 countries in its kitty at the moment, with about 47 governments also across the globe as its clients. And well, it has a very attractive acquisition. In terms of weaknesses, well, valuations of course will be one of those factors which will play against the price of the company, and maybe, just maybe, the small creeping up of gross debt is something that we're going to take up with the management as well. But Mahima, what about opportunities and threats?
Right. In terms of opportunities, they themselves mentioned that the air travel demand looks pretty strong. I mean, the passenger load factor in the aviation industry is on the rise, and the overall global air passenger traffic is set to grow around 1.5 times by 2030. The growth in outsourcing of visa, applicable worldwide will also rise on the back of this, and they are set to capture growth by cross-selling under digital services as well. So these are the opportunities for the company. In terms of threats, two particular threats. One is data security, because they deal with a large amount of data, and this is personal data. So this could be one of the possible threats. And the second one is technological developments. I mean, they will have to keep up with what the technology is being developed like, and if they don't keep up with that, this could be a possible threat for the company. So these are the opportunities and threats when it comes to BLS International.
Okay, all right. Well, I guess it's time to bring in the management of the company. We have Shikhar Agarwal. He's the chairman of BLS International. Shikhar, good morning and thanks for joining in. We were just going through the financials of your company, and so far, well, things look very, very strong. I think my question then is, based on the kind of 9 months of business that you guys have done, which also looks very, very heartening, what's the way forward over FY26? What is the expectations in terms of your growth rate for the top line as well as the bottom line?
See, if you look at the consolidated level, our revenues have grown upwards of 17%, compared to the same quarter last year. Our EBITDA has grown by more than 80%. We stand at an EBITDA of 158 crores compared to 88 crores last year. So there has been a major growth, and important point to note is that this financial year we've done acquisitions of upwards of 1,000 crores of through internal accruals, and we still have around 690 crores of net cash on the books. So going forward, our objective is to maintain the numbers. We have reached a 30% EBITDA margin percentage now on a consolidated level. If you see, our acquisition numbers are not fully in the system yet. From this quarter onwards, numbers should start coming at 100% for all the acquisitions that we have done this year. There are multiple tenders that we are bidding for. We expect also, we are looking at more inorganic opportunities for growth. So our target is to maintain the EBITDA percentages, the numbers that we've achieved in this quarter, and going forward, seeing the growth that we've achieved in the past, we think that we are at a good position as a company.
Shikhar, Mahima also joining in. I just wanted to understand with respect to the gross debt of 230 crores in your balance sheet, what kind of debt is that, and by when do you expect to, get net debt free again? Gross debt free, because you're already net debt free. Your cash flow is pretty strong.
Correct. So we are already net cash position is around 700 crores. We have around 920 crores on the books. But if you see, so we can, for when we did some acquisition in one of the countries for some tax purposes, etc., we had to take some debt locally, to pay off the acquisition price. But it is up to us right now. So we are at a very healthy position, as a company. And going forward, the kind of growth that we expect, we definitely see more cash coming into the company. So we are looking at effective ways to deploy that cash that is further generated through organic as well as inorganic opportunities. There are multiple tenders that we are bidding for. If we win certain market share, we'll have to deploy certain cash for deployment of the offices across the globe in technology, etc. And also inorganically, we are looking at service industry globally, companies that can help us synergize our operations, profitability, etc. So if you see, as a company, we have solid parameters right now.
All right. Shikhar, stay with us. We'll just cut across to my colleague Alex, who is going to give us an analysis of the AMFI data. Alex, over to you.
Okay. Very critical to look at this data with a very close lens, because we've been speaking about potential redemption pressure in the broader end of the spectrum. And we told you this morning that the numbers for January would actually look good. And that's exactly what has panned out. Because take a look at the overall inflows into actively managed equity mutual fund schemes, and that is stood at 39,687 crore rupees. And if anything, it's better than the month of December. You look at inflows into some of these key categories, you look at particularly mid cap and small cap, and you see inflows, net inflows to the extent of 5,147 crore rupees or 48 crore rupees into mid cap funds, and 5,720 odd crore rupees into small cap funds as well. So those numbers looking very, very strong. Thematic, which has been a very key category in terms of the inflows into equity mutual fund schemes, you've seen inflows to the extent of 9,000 crore rupees. And what is interesting to note is that a large part of this is not in the way of new fund offers. Yes, there were new fund offers. There was only one small cap fund that was a new fund offer that has garnered about 1,040 crore rupees. There were 3 sectoral and thematic funds that have garnered 2,838 crore rupees. So total of 3,900 odd crore rupees of inflows from new fund offers out of the 39,687 or 88 crore rupees. So if you think about it, a large amount of the inflows are in the way of SIPs as well as in lump sum investments. The insight that I've gotten is that the lump sum investments have come in, but they have not been as elevated as you perhaps saw in July. I will remind you, in July last year was when you had the election result and you had a sharp drop in the equity markets at that point, and a lot of people deployed funds at that moment. So you had lump sum investments of 50,000 plus crore rupees at that moment. In fact, the average has been closer to about 35,000 or 37,000 towards 40,000 crore in the way of lump sum investments. And of course, you know about the SIP number as well. That had a record high in December. We will know soon enough. The call happens at 12 o'clock and we'll find out what the SIP number was for the month of January. Don't be surprised if that number is lower, because you've seen a higher number of cancellations. What we do know is that on a consistent basis, the net number has remained more or less where it was several months ago, around that 9,000 crore number. So despite the gross number being closer to 26,000 crore rupees, the net number, which is net of cancellation and stoppage, has actually been close to that 10,000 crore mark, but it's been very steady. All of those things are positive. Let's look at another category. And here you talk about hybrid, which is emerging as a pretty important category for the mutual fund industry as a whole. Even that has gotten inflows to the extent of 8,767 crore rupees. And what is the breakup here? You have multi-asset funds that have continued to get a decent amount of inflows, over 2,000 crore getting into these schemes. And arbitrage funds have also gotten inflows of over 4,000 crore rupees. What else do you need to know about? Overall, for the mutual fund industry, they've gotten inflows of 1.9 lakh crore rupees, and this is a very large amount that has come through. It is because you have significant inflows into fixed income mutual fund schemes, and this is normally what happens at the start of a quarter. January, understandably, would see a lot of institutions put money back into fixed income mutual fund schemes, and largely you're talking about the liquid and the overnight funds. So if I look at the inflows into liquid funds, it's to the extent of 91,600 odd crore rupees in the month of January. And if you look at ultra short term or overnight funds, actually overnight funds have seen an inflow of close to 19,000 crore rupees. The money market funds, which are also short term in nature, have gotten 21,900 crore rupees. So this is par for the course. What you should be focusing on, however, is the inflows into equity mutual funds, which have remained very strong. The other number that I would want to check is the index funds, which is mostly equity index funds. Again, it's a very robust number, 5,250 crore 5,255 odd crore rupees coming in as net inflows into index funds. Akhil Chaturvedi is joining us. He's Chief Business Officer and Executive Director at Motilal Oswal. Akhil, thanks so much for taking the time.
Thank you, Alex. Thank you.
Yeah, so it's an important day to be talking about these numbers. The insight that I got from speaking to various participants in the industry is that the month of January was actually better than the month of December, and that has panned out. The question mark is not about that though, Akhil. Those numbers look great. The question mark is about the redemption pressure in the month of February because of certain panic that is set in about the broader markets. What would you say about both of those two data points?
So Alex, certainly January month has gone pretty okay, honestly, given the kind of panic which had already set in the month of January, both globally and then locally, the FI selling pressure. One would have thought that probably the pressure on the sales would have been there, but the numbers which have come is very, very encouraging, and actually we have seen a tidbit growth in the net sales numbers as compared to the month of December, which was pretty good. The first few days of, we are on 12th of Feb, whatever numbers I have been tracking, honestly, I am not seeing any redemption pressure so far. A little bit slowdown on the gross sales, but the net sales is not really impacted, at least in the first 12 days.
So I'm looking at the gross sales in the month of January versus December, and you're already seeing a bit of a deceleration, not very dramatic. But talk to me about your reading of this, because if I look at the month of December and if I look at the NFOs, there were about 11,400 crore rupees garnered for the industry through NFOs, whereas in the month of January, that number is only about 3,900 crore rupees.
3,900, yeah.
And so from that perspective, is it fair to say, Akhil, that the inflows through lump sum have been robust?
Yes, you are absolutely right. And NFOs clearly, if the markets continue to be the way it is, then there would be a slowdown in the NFO numbers, and we would see stability in the existing, all the existing products. So NFOs is going to be a little tough for now, at least.
Talk to me about incremental investments that you're seeing, and maybe some of the chatter as well. You will be aware of your peers and how the industry is also seeing inflows. Akhil, how are the large investors investing, and also how are the retail investors investing? If you have looked at some of the granular data here, what are the family offices, for example, saying and doing, and what are the retail investors doing?
Retail, there is continuity of inflows. I think I mean, for the last couple of months, I've been doing these shows, and there was always this question that if the markets go down, will we see a drop in the flows? Will we see investors pulling off? Will we see the redemptions going up? Will we see the SIP numbers slowing down? I think clearly over the last few months, what we have been seeing, and I hope I'm proven right, is that investors have matured. In fact, investors are trying to take the opportunity of dips to continue their flows, if not add incremental flows. So that maturity seems to be there so far. The real thing we have to see is that for the next couple of months, if you continue to drag like this, will we see a dip at all, if at all or not? In terms of client segments, I think retail, as I said, continues to be steady. We are not seeing the large checks as of now. So maybe the family offices or the larger ultra HNI clients would be waiting and watching for some time. But the retail flows, not really seeing any major dip, honestly.
The question arises then, Akhil, where is the selling coming from? Because, okay, you've looked at this week in particular and the kind of drawdowns that you've seen in broader market portfolios, or portfolios that are gravitating towards the small cap side in particular. Of course, we're off the low point of the day today. But then, isn't it mutual funds that are selling? If not them, then who?
It's $1 million question, honestly, which I keep asking because, yeah, you have on one side large selling, which has come from the FIIs, and large part of the FI selling would be in the large cap space, although they still have some holding on the mid and the smalls. But clearly the FI sales is not impacting the mid and small cap correction. Now, mutual funds, you have the numbers right up there. We've seen net positive sales in the mid cap, net positive sales in the small cap. In fact, we have seen some NFO collections also, which is largely going into the mid and small pockets because of the sectoral. So there again, the selling pressure is not there. Maybe few managers in the existing products. I've not seen the data, but this is probably my gut. Maybe few managers would have built some cash position in their portfolios. So one needs to go inside those data, especially in the mid caps and the small caps. Maybe some selling coming from that part. Rest, I think it could be some of the other institutions, larger institutions, or maybe it could be in the direct equity from the HNI, ultra HNI family office desk. Maybe there is some selling coming over there. Probably there could be some housekeeping around, the year-end kind of issues. So it's not to do with the mutual funds, honestly. I don't see that happening right now.
Okay. Akhil, last question on SIPs, and I have not seen the number for the month of January. But I was speaking to somebody yesterday, and what they were suggesting is that what was booked, and we're not talking about the overall gross, was close to about 19,000, 20,000 odd crore is what I heard. But
yes, that's right.
Right. So it's not a bad number, but it's lower already than the month of December. What does that tell you? Because you are seeing elevated numbers of cancellations. Is that something that will continue as a trend? Of course, you can't tell, but then will there be an implication of that in the ability of mutual funds to deploy further?
So the final number will come in sometime. I mean, I have not seen the final number, but yes, what you have on hand, 20,000 crores is the right number. Now that's according to me 86 or 87% of the industry. So when you see 100%, maybe I think in December we were 26,000 thereabouts. It could be maybe 100, 200 crores plus minus. Maybe not a great jump. I think December we saw the number jumping up from 25.5 to 26 to 26.3. Maybe it might be 100, 200 minus plus, not a major decline, at least for the month of January. Alex, all I can tell you is that if the momentum actually starts to die down in the markets and it sustains for maybe next 1 quarter or 2 quarters, let's say next 6 months, at least what history suggests that maybe there could be some slowness or slowdown coming in the retail momentum, in the SIP flows, in the lump sum flows as well. So we need to wait and watch. Honestly, I'm tracking this data at least, every week when we get the data, we are tracking this and seeing if the trend is changing. For now, things seem to be okay. While I'm saying that in Feb, we are seeing some slowdown, but net is still positive. So I like to watch the net number. Net positive sales is a very happy thing to, or happy state to be in.
Very, very quick last answer on this. The net number on SIPs has been the question mark, right? Because despite that 26,000 number, the net number is very dramatically lower than that. So how long do you think that this will continue? And is this par for the course? Is there anything that should be a red flag here?
No, so the proportion of, let's say, the number which on a gross basis, what we see is about 26,000 crores. We don't have the facts in place. The real number is not known to anybody. There are some operational issues, but I would say that this typically rotates between 55 to 65%. So that means on a 26,000 crores of SIP flow, the real cash flow coming into the markets would be more like 17,000 crores. Right?
Okay.
So
my number is closer to 10,000, Akhil.
No, not that low. Not that low. The last report which I had gone through was from Cafe Mutual. They had done some study on this about 8 months back. It was 50%. So if I go with the 50%, then 26 divided by 2, it's 13,000 crores. But some of my other industry friends, there are varied opinions and numbers out here. So I'm just trying to be in middle. So if I take 60%, then we should be 16,000 crores, and that's the right number we should all track. Now there are certain operational issues between how the data flows between the platforms and the AMCs in terms of actual SIPs getting realized, SIPs getting closed, because of which unfortunately we don't know. But I know for my AMC what is my gross number, what is my net number, and if I just take that ratio, that's the extrapolation I'm doing.
Fair point. Akhil, thanks so much for joining in, and I will be speaking to you hopefully over the course of the next few weeks to try and understand, and hopefully this settles down.
Absolutely, Alex.
I look forward to that. Thank you so much for joining.
Thank you, Alex. Thank you so much.
All right, that brings us to the end of this special broadcast. Do stay tuned. Lots more coming up on NDTV Profit.
entire special package and measures are kind of focused on AI skilling and how to sort of facilitate the AI centers which is existing at this point of time.
Now a center of excellence in artificial intelligence for education will be set up with a total outlay of 500 crores.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Sources telling us is that government is expected to provide a roadmap of the next phase of national monetization pipeline, where they are going to set a higher target for the next fiscal onwards.
Building on the success of the first asset monetization plan announced in 2021, the second plan for 2025 to 30 will be launched to plow back capital of 10 lakh crore in new projects.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with.
Sources telling us is that government is expected to provide a roadmap of the next phase.
And welcome, you're watching NDTV Profit Top Buzzers. Nifty's seen a strong earnings per share cut and valuation correction from its high. And, to break that down for us, we have Anushi joining us to give us all the details.
If we see what has happened over these three indices, we are seeing some strong cuts, especially with small cap. We've seen in the previous few sessions the small caps being quite under pressure. It was down about 3%. Even in fact today also it was down about 3%, but from there on it has marked a strong recovery. If you look at the EPS cut from the highs which were there, 9.8% is the quantum of the cut that we are looking for in terms of where the 1 year forward EPS was from its peak levels. Mid cap 150 and Nifty 50 we are seeing about 2.11% and 2.4% of a cuts as well. Coming to what this EPS cuts has done with the valuations for all these three key indices that we've talked about. Now, if you see valuations at peak, Nifty 50 valuations stood at about 21 times. Now, this has come down to 19 times. However, it's mid-cap 150, which is a standout over here, seeing the most correction in terms of their valuations. 36 times was the multiple earlier, which has now come down to 29 times. Small cap 250, we are seeing the multiple of 26 times coming down to 22 times. But let's see in the Nifty 500 universe, which are some of these top 5 stocks, or rather the top laggards, which have seen the highest EPS cut. So first one emerging on the list is Chennai Petroleum, seeing about a 55.4% of cut from its EPS from where its highs were concerned in this 1 year period. GMR Airports and Jubilant Pharmova are the next on the list, seeing about 52 to 53% cuts as well. Chemplast, Sanmar and Westlife Food World have seen 47 to 49% of cuts, while Aster DM Healthcare is the last one on the list, seeing about a 45% cut in its EPS from the highs which it was there before. Now, considering the EPS cuts, we'll also see some correction in terms of where the valuations are concerned. But we are looking at some of the counters, the valuation despite the EPS cut that has remained same. So what is important here is also that the trailing PE is more important to keep a track of rather than just looking at the forward PE. Chennai Petroleum, the valuation at peak stood at about 12 times, which has now come down to 8 times. Jubilant Pharmova, not seen much of a difference here. 36 times was the multiple earlier, now which has shifted to 34 times. Chemplast, Sanmar, same multiple. It's currently trading at 37 times. This is the forward multiple PE multiple that we are looking at. Westlife Food World remains expensive with 188 times of a PE, which has now come down to 165 times, and Aster DM Healthcare 59 times, which has come to 49 times. So in terms of where the Nifty 500 universe is concerned, these are some of the top constituents in which EPS cuts have taken place and what their valuations currently stand, and this is the whole picture that we are seeing.
Thank you, Anushi, for giving us those details. Let's welcome our guests. Joining us now is Brijesh from Retail Research at IDBI Capital and Gaurang Shah, Head Investment Strategist at Geojit Financial Services. Brijesh, I'll come to you. Anushi, one of the stocks that has seen sharp EPS cuts is a Westlife Food World, 47.9%. Yet valuations remain high. But on the charts, what's the picture that Westlife Food World shows?
Fine. Okay. So I think it's currently it's slightly declining. There has been a slight profit booking what we can see in the counter. So, but directionally, I think it can come back to some 720 odd levels, because that is the area from where it has taken the demand zone. It is more of a sideways kind of a counter, not too much of strength. The recent distribution suggests that can be a further correction. So, but then one would have a cautious view. Maybe when it comes back to 720, 730 level, there can be some formations can be there, but on an immediate basis, some further selling can be there in this counter.
Right, there could be further selling in terms of Westlife. Gaurang, coming to you, I'll pick up two counters, Jubilant Pharmova as well as an Aster DM. If you look at both these names as well, in terms of the EPS, a cut of almost around 45 to say 53% is what we've seen. And in terms of valuation, not a major downtick on a Jubilant Pharmova, but Aster DM almost from 59 times, it's currently at around 49 times. What would you advise investors to do with both these counters?
Well, unfortunately, we don't have coverage on either of them, so I won't give any specific recommendation. But Jubilant Pharmova, I think this is one company that is looking quite interesting in terms of earning visibility. Though there has been a little bit of disappointment in terms of price correction. But remember one thing: these stocks did rally when the markets was going on up north, and they really outperformed. So whenever markets have corrected, the ones that have rallied the most would correct the most.
Gaurang, shifting focus, in a market where valuations are always a talking point, we're bringing you the cheapest stocks within the Nifty 500 universe, but that are outside the Nifty 100. Rucha joining us with the details on the stocks that are currently trading at the cheaper valuations. Rucha?
So now I'll talk about the stocks which are at its cheapest valuations. My universe includes Nifty 500 stocks, but excludes the ones which are in Nifty 100. And the case one is wherein my stocks will be listed according to their FY25 PE ratio. These 5 stocks with the cheapest FY25 PE ratio includes Great Eastern Shipping Company, NMDC, Jindal SAW, Oil India and National Aluminium Company. So the kind of PE range over here is from 6 to 10 times, and if you look at the FY26 PE of these same stocks, you will also see a kind of 7.5 to 8 kind of range is what we can see over here. So these are the cheapest stocks, but my case too includes the stocks according to their FY26 PE ratio. Now interestingly, there are two names which are overlapping in these two cases. Number one is Great Eastern Shipping Company and number two is NMDC Limited. The other three stocks in case 2 are Godavari Power, Chennai Petroleum and Hindustan Petroleum. And over here also, as you can look in your screens, is the FY26 PE ranges at about 7 times to 7.5 times over here. But interestingly, the FY25 PE of these same stocks are quite high, ranging about 6 times to 43 times. Have a look at Chennai Petroleum. This one is at 43 times FY25 PE, but FY26 PE is at just about 7.14 times. So interestingly, these are the stocks which are the cheapest ones in my universe of Nifty 500, excluding Nifty 100, of which two names overlap, namely NMDC and Great Eastern Shipping Company.
Thanks, Rucha, for that. Let's just quickly pull up a PFC on the screens. Total income, a 13 to 14% up move is what we are seeing right now on the top line. That's the number that's come in. The stock is at the day's highest levels as we speak. If you see in terms of the net interest income, 16%, 9,840 is what the net interest income has come in at in terms of where PFC goes. And in terms of the profit number, a 5,829 crore, which is an uptick of almost 23 to 24% in terms of the counter. So pretty good number in terms of what the street is looking at, because the stock is also trading at the day's highest levels, and a third interim dividend of 3.5 rupees per share that has been declared. But Gaurang, coming to you with regards to the 4 to 5 companies that Rucha was talking about, GE Shipping, NMDC, Jindal SAW, Oil India, as well as Analco. Cheap in terms of valuations, in fact, cheapest stocks in terms of the Nifty 500 universe, excluding Nifty 100, right? Would you like to pick any of these that could be buying opportunity right now?
So Nalco and NMDC, Hiral, will be the two investment ideas we have coverage over here. And we believe that, and of course, we all know what's happening with the entire metal pack, thanks to the 25% tariff on aluminum and steel products across. But we believe the domestic growth story is quite good. Operating margins have improved due to the efficiencies that these companies have put in. And there is one article that I also read, Hiral, that says that possibility of rising prices upwards, not for flat and long products, HR and CR coils, is a likely possibility which may improve the earnings visibility.
Rajesh, I'll come to you as well. I'll take the same counter, something GE Shipping or an NMDC or an Oil India or an Analco, anything on the charts that looks good?
Maybe to some extent, I think HPCL is something which I was keeping a watch on. So eventually this level of 300 and 315, this is a very decent demand zone. So I believe there is some amount of bounce is to be expected. Then HPCL, from the risk reward ratio, it is quite promising. So maybe maximum pain can be 310 or on a worst case scenario 300. So very limited downside. So that is one stock. PFC is also one more counter where I think at closer to 380 level, maybe the pain would be more, maximum 20 points. So from the risk reward point of view, I would bet on HPCL and PFC.
Got it. Counters like HPCL, PFC, NMDC, Nalco, something that's common is they are all PSU stocks, and that brings us to the next part of the segment, and this is how much public sector undertakings have lost in 2025 so far, and aggregate a market cap of 8 lakh crore rupees has been lost in the PSU universe. In terms your aggregate market cap has fallen 13% in 2025 so far, and not one single PSU stock has gained in terms of market capitalization. When you look at the top losers, up first we have KIOCL. In percentage terms, it lost 33% so far as of today. BML, 31% market cap lost. ITI, 30%. RITES is at 29% and Titagarh Rail is at 26%. Amongst the large caps, the government-owned large caps have lost around 12.5% of market cap in 2025. The top losers mainly being REC, IRFC and PFC, and ONGC is the one that has lost the least amount of market capitalization at 0.8%. Among the mid caps, you have 13.5% of aggregate market cap lost. Top losers include New India Assurance, HPCL, and HUDCO. And Bank of India is the one counter that has lost the least market capitalization to the tune of 1 to 2%. And in the small caps, they've lost the most, 14% on an aggregate basis in 2025 so far. You have the same losers that I spoke at the start: KIOCL, BEML, and ITI. And it's Gujarat Narmada Valley which has lost the least. And lastly, when you look at the sector-wise loss, power is the one thing that stands out: a 15% market cap loss on an aggregate basis of the PSU companies, followed by an aerospace and defense, 14% market cap loss. Insurance as well, 14%. When you look at banks and the oil and petroleum product segment, they've lost 13% in market capitalization. And lastly, it's construction at 12%. And it's your metal and mining pack that has lost the least, but 10.5% nonetheless.
So this is interesting. In fact, Gaurang, if we come to you on all these names that Mika was mentioning, again, though we are caught in a bear market right now, any bulls in the offing that you see probably from this space which has seen an absolute market cap erosion?
Well, Mika was firing the names left, right, and center, and actually quite over my head. But I mean, if I had to just elaborate on sectorial themes, then my sense, Hiral, is that defense. She mentioned power, if I'm not mistaken. That looks quite interesting. PSU banks, she mentioned, I think, Bank of India, I think the list that she was mentioning. So these would be the, sectorial themes and picks that we would possibly be advising people to look at. But having said that, defense and power, since I've taken these sectorial names, I think it would be prudent on my part to also advise that don't have 1.5 year kind of time horizon in power, defense, or even cap goods engineering or railway related stocks. Or, you need to have at least 2.5, 3 years plus kind of time horizon. That's purely, Hiral, because, these are depending on the kind of order book that they have and execution of that order book. And most of these sectorial companies have, operate in a very challenging environment in terms of precision, technology, and know-how. So you need to have that kind of time, right?
Interesting. In fact, we just have a Graphite India which has reported numbers right now. We spoke to the management of HEG as well. Revenues, in fact, for a Graphite India are down around 24%. In fact, the company has actually reported a loss this time around, and that's the reason why you're seeing this kind of a downtick that's coming in on the counter. It hit a day's high of 466, currently trading at 430. A sharp downtick coming in on the counter. 523 is the revenue number. EBITDA loss of 8 crores versus a 13 crores is what you're looking at in terms of Graphite India. Small one, but because we spoke to the management of HEG, just an important one to mark that. In fact, Brijesh, coming to you on few of the companies that Mika was talking about from the PSU space which have been beaten down. Look at a BEML, Rights and Titagar. 3 counters which have a lot of investor retail interest as well. What are charts indicating? Do you think a cut of around 26 to 30% does now warrant an upside, or do you think there is further pain remaining? What are charts indicating?
So coming to BML, the structure is very weak. In the weekly time frame, there has been a distribution and it is making a lower low. So maybe a small bounce back can be there, but then taking a directional view would be very difficult for a specifically BML. But but if I look to this rights, I believe we are somewhere close to this support zone at 218 level. I believe 200 will be the major level. I think it will be respected, and somebody wants to take that call with a stop loss below 200. I think risk reward ratio is quite favorable, and we can be speaking of 15-20% kind of a bounce. So there is definitely a trading opportunity in rights. Titagar is one stock which we were liking earlier, and we had the positions in this, but then lately there has been a very there's been a very sharp correction. So, but then again, from the weekly point of view, this level of 850, 830 is somewhere demand zone. Previously, during the month of March 2024, this was the level from where the stock has started to rise, and now it is exactly back to that support level. So I would taking a small trade, maybe with a very strict stop loss of 800 at 800 levels. So maybe a 20-25 point surface stop loss, and I would take the long bets. The bounce would be somewhere close to 1100 to 1150. Time frame is a bit difficult how it will take, but then an opportunity is there in Titagar, rights, and then BML I would be avoiding.
Got it. Thank you so much, Rajesh and Gaurang, both of you all for joining us, and getting us your perspective. But with that, we're shifting focus back to the markets. The Nifty has declined 2.4% so far in 2025. Meanwhile, big bulls lose almost 6,000 crores. Now, who are the top losers? Well, Samit joins us with the list.
Well, yes, the top 10 big bulls in the market have lost close to 6,000 crores so far in 2025. And one of the big bulls, Radhakishan Damani, is the only one which has seen a green, in fact, an uptick in its portfolio, but that is largely because of Avenue Supermart's share price gain that we have seen so far in 2025. Now, if you remove Avenue Supermart's, even Radhakishan Damani has lost around 13% of its portfolio, and the top 10 bulls have lost close to 9,300 crore rupees. Now, coming to the top 10 bulls of the market, Radhakishan Damani has seen an uptick of around 2.6% in its portfolio. Ashish Dhawan has seen the least decline of just 9%, a 300 crore downtick in his overall portfolio value. Apart from that, if you look at the portfolio of the Jhunjhunwala family, they have lost close to 6,000 crore rupees, that is 9.1%. Ashish Kacholia's portfolio is down by around 300 crore rupees, around 11% downtick in its portfolio. Mukul Agarwal has seen a downtick of around 11.6%, while Akash Bhansali has lost close to 900 crore rupees, that is 13.5% downtick so far in 2025, followed by Nimesh Shah, who has seen a downtick of 14%. Madhusudan Kela's portfolio is down by around 500 crore, that is a 15% downtick in his portfolio so far in 2025, followed by Vijay Kedia, who has seen a downtick of 15.5%, and Sunil Singhania has seen the worst performance so far, around 17% down. That is his portfolio so far in 2025. Now, which are the stocks that have hurt them the most so far in 2025 as in percentage terms? For Radhakishan Damani, it's Trent, which is down around 27 to 30 odd percent. For Jhunjhunwala family, it's Style Bazaar, which they are the promoter of this company, and this company's share prices are down around 30% so far in 2025. Followed by, for Mukul Agarwal, it's Raymond Lifestyle. For Akash Bhansali, it's Paytm, which is down around 20 to 30 odd percent in 2025. Followed by, for Ashish Dhawan, it's AGI Greenpack. For Nimesh Shah, it's Lakshmi Machine Work. For Madhusudan Kela, it's Neogen Fintech. Though this stock is not a big chunk of his portfolio, but this is down the most so far in 2025. For Ashish Kacholia, it's Zaggle Prepaid, and in fact this stock has seen a downtick of nearly 20 odd percent in the last couple of days. For Sunil Singhania, it's IFL Securities, which is down the most in 2025, and for Vijay Kedia, it's Tejas Network, which has declined the most so far in 2025.
Thanks, Amit, for getting us the details. So, no one is spared in this kind of a bear run that we are watching out for. But let's quickly look at what brokerages have to say and what's their view on the entire small and mid-cap space. We have Harshu standing by to get us more in terms of what brokerages are making out of it. Harsh, over to you.
This is very interesting, right? You've got so many views coming through. And we have one from Kotak and one from Bernstein that I'll quickly sum up. One is what Kotak is suggesting. Well, they're saying that they're reading the minds and wallets of the retail investor, and the retail investor will largely determine where markets go as well over the course of the next few weeks as well as months. They're saying that analysis shows that the returns of retail investors so far have been lower than the returns of SMID indices. And therefore retail investors have invested more funds at higher market levels as well. So those are the two big pieces which they're talking about. Also the third piece, and critically, new investors haven't had a great experience, and it's going to be very interesting to see whether they stick or not. The older investors have possibly poured larger sums of money at higher levels, so you may have to be cautious of that. And could the breaking point of investors be a lot closer than is generally believed, because you have so many new investors who have come on board and they haven't had the best experience, or they've bought in at higher levels, and that's what the Kotak note really talks about. The Bernstein note also equally interesting. They're calling and they're saying that the small and the mid caps were in a bubble and they called it for a while, but strong domestic flows have supported stocks. Now the SIP numbers, including the ones today, continue to support the thesis that domestic flows continue to remain robust. Small and mid cap though have been down 15% from the peak in October, but they're still at multi-year highs nonetheless. And the small caps, the risk is there are plenty of risks of further correction as per Bernstein. Foreign outflows should stop, and likely a domestic reallocation will likely trigger a better performance in H2 is what Bernstein is saying. Don't see a reason to bottom fish though at this point in small and mid caps. They believe that there could be more opportunities going forward to play out in H2.
Yeah. Thank you, Harsh, for bringing that perspective in. But a strong correction in markets have led to fears among investors over SIP investments. Now, we spoke to Edelweiss Mutual Fund's Radhika Gupta, who explained why it is never a good idea to stop your SIPs. Take a listen.
In our funds, given the SMID funds and the fact that they are extremely retailized and they don't have investor and distributor concentration, if there is a slow of redemptions in February, which we have not seen, we are net positive, I don't think we will have any liquidity problem at all. I can't speak for every fund house in every scheme, but I think what I am saying is true of many players in the industry. The stress test data is in public. You know who has funds that are potentially more stressed because the number of days to liquidate is higher. The answers are there.
Okay, Radhika, my last question to you at least, and it's a difficult one to ask, especially to a CEO of an AMC, but because you referred to that earlier, I'm not going to hold you to that. It may well be the famous last words, what have you, but does Radhika Gupta believe that this is arguably one of the better times in the last 6, 12, 18 months to start an SIP? Every day we have new investors coming in. Is this a good time to start an SIP versus stopping it?
It's certainly, and you know, all these words become clickbait stuff. So I think
okay.
So let me answer this as best as I can. It's a bad time to stop an SIP for sure. And honestly, if you're making a 10-year SIP, a 15-year SIP, at least a 10-year SIP, let's not go into 15 years. I don't think it's a horrible time. Don't hold me to that. I will say it's certainly a bad time to stop an SIP if you've been an SIP investor.
Bad time to stop an SIP. That's the word coming in from Radhika, but very interesting. Few factors that we should be watching out for will be the RBI supporting the rupee, the GST council meeting dates that could be announced quickly. So that's what the street is watching out for. You have seen some bit of positive commentary from the finance ministry as well. And you have Modi meeting Trump today and tomorrow. So these are aspects that the markets and the street will be watching out for. But completely out of time. With that, it's a wrap on this edition of Profit Buzzers. Lots more lined up on the other side. Please stay tuned to NDTV Profit.
entire special package and measures are kind of focused on AI skilling and how to sort of facilitate the AI centers which is existing at this point of time.
Now a center of excellence in artificial intelligence for education will be set up with a total outlay of 500 crores.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Sources telling us is that government is expected to provide a roadmap of the next phase of national monetization pipeline where they are going to set a higher target for the next fiscal onwards.
Building on the success of the first asset monetization plan announced in 2021, the second plan for 2025 to 30 will be launched to plow back capital of 10 lakh crore in new projects.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m.
Hello and welcome. You're watching India Market Close here on NDTV Profit. I'm Harsh Saida. Quickly looking at where the Nifty is at. While it's been a day where we've, somewhere we saw a bit of a recovery, but we've slipped back in the red as we speak. We're still holding the 23,000, which is likely the only key positive here. Let's pull up the Nifty 50 intraday, zoom in on that, and there you go. So we've recovered quite well from the lows, 200 plus points higher, but we've slipped thereafter. In fact, the day's high is nearly 300 points from those lows. So, and that's the texture across. So even broader markets, you'll see very similar structure. Let's look at the Nifty mid cap as well. There you go. And the Nifty small cap as well. So around 0.7% lower on the Nifty mid cap. Small cap seeing a little bit of more pain, 1.2 odd percent lower, but it's definitely better than what we saw in that early first 2 hours odd of trade. So the recovery seems to be okayish at least, even though we are still sitting 1% plus lower. Just the fact that we bounced back nearly 400 points from the lows on the Nifty small cap is really heartening to see in that sense. Let's look at the Nifty 50 heat map. Try and zoom in and also you'll also get a sense of how the breadth is looking, especially on the large cap end of the spectrum. Life insurers doing well, financials doing well, cement, steel doing decently well. So some of those names as well as pockets doing decently well for themselves. What's not doing well is an M&M, a BEL, an ITC, Power Grid also languishing. It's been quite a few days where we've seen pressure on something like a Power Grid, additional capex also to come through for the company. Let's look at the sectors as well, the sectoral heat map. And there you go. The PSU banking index seems to be resilient today. Nifty metal also showing some signs of resilience. What's not doing well again is realty. That's the one pocket where pain has been there on Monday, Tuesday, and now again today. 3% lower on both Monday and Tuesday, 2% lower today as well. So some pain on that front. We'll take views, of course, try and get a perspective on what next for realty, because that's the one pocket where there's pain. Auto is down 1%. IT is also down 1%. But let me quickly welcome on board our guests. We have Kush Bora from kushbora.com, Shivangi Sarda from Motilal Oswal, as well as Sonam Srivastav. All three of them joining us today afternoon. Let me start off with you, Kush, first. What do you make of the recovery from the lows? Do you think that the Nifty still is in a precarious position and we could still slip lower from here? Or do you believe that we could well see some bit of a recovery going forward?
Hey, hi Harshit, very good
afternoon. Hi, good afternoon.
Hi, Shivangi, hi Sonam. Well, I think this recovery that we saw is more technical in nature than anything else. If you'll recall, yesterday we spoke of the Nifty PCR being at 0.66. It slipped lower during the day. Now it's somewhere hovering hovering somewhere closer to the 0.82 mark. So that itself is an indication that this was more of a technical bounce, and we all kind of knew that was coming in the sense that 5 days of selling, some short covering, is par for the course. Also, it's come from the low levels that the Nifty had hit, somewhere in the middle of January or end of January, 750, 800 thereabouts. So double bottom being made, but I think this is very fickle in nature. I wouldn't really ride on this one. I actually wouldn't be surprised to see the Nifty move about 300, 500 points from here, 23,300, 23,500. But that's actually the resistance band, which will actually create a shorting opportunity for fresh short additions. So quite fickle, more technical in nature of the bounces, and as we've seen, after hitting that green zone, Nifty is already back in the trade. So I think this is not something that you should be very gung ho about. Just something that the markets have seen on technical grounds. I will actually look to cover my shorts if I had any. If the Nifty does maintain the 23,000 mark, could trigger a bit of a further short covering rally.
Okay, Shivangi, your quick take with regard to technicals.
So absolutely, we've seen that Nifty has been witnessing some sort of a pullback move from the morning lows, but then again, overall the texture of the market is something which is not in much strength right now. India VIX has been disturbing. The put call ratio has been decreasing from the last 3 to 4 sessions. It's now at 0.69 odd levels. So overall, we are seeing that there is a lot of call writers that are gaining and strength at this kind of hour. And we've seen that from the last 6 trading sessions, there has been continuous lower top, lower bottom formation. We are near a crucial support levels, and 22,800 is something that we are backing out at. So 22,800 will be an important level to watch out. And the upside hurdle is now shifting lower to 23,400 marks. So market is expected to remain in this range since we've fallen in the last 3 to 4 sessions in great intensity. We are looking at 22,800 as an important level, where we've seen a recovery in today's session as well. Even on the 27th Jan day, we saw that this level was important and respected. So this is what we are looking at in an immediate level. But overall, we are expecting consolidation going forward here. However, banking stocks have been comparatively more resilient than the overall Nifty index.
And do you expect that resilience to somewhere sustain?
So talking about Bank Nifty, of course, 50,000 was an important level which has been broken. But overall, we are, expecting the heavyweights to somewhere show some sort of strength and, some support to the entire market. So now, of course, there is a lot of, resilience and resistance at 50,000 levels, which we are looking at next. But then again, 48,750 is an important mark, which the banking index is not looking at to break. So this will again be an important level to watch out. But overall, the way the open interest is adding in the banking heavyweights is clearly showing that there will be some sort of consolidative move over here, if not much pain. So 50,000 on the upside with a support of 48,750 levels.
Okay. Okay. Point taken. Sonam, let me come to you. So Sonam Srivastava, founder, fund manager at Right Research. Sonam, if I can take your quick viewpoint as to what you are doing at this point with regard to how are you playing markets, or are you staying away?
No, we are still invested, and obviously, like both of these guys said, that this is a technical sort of a rebound that is happening. I think the market is going to play around in a range-bound fashion because the whole pressure that is coming on the market is because of the trade war that is going on in from Donald Trump and in the US. So what we are doing right now is studying a lot about that trade war, trying to understand what sectors, industries on the macro level could be impacted and how we can position our portfolios. But yeah, I think there's been a significant pain in the smaller sectors, small and mid caps. There will be recovery in select stocks for sure. But I think we have to bring in a tilt towards slightly larger stocks. Again, in terms of sectors and industries, also you talked about banking. I think banking, even in the previous trade war, stayed strong. Similarly, there's a lot of interesting picks we are seeing in differentiated sectors like textiles, hospitals, and chemicals, etc. So we are selectively buying, but yeah, we are being cautious with the market.
Before I come to names on that count, Sonam, let me go across again to Kush. Kush, your one sense with regard to the Bank Nifty, and if I can in fact even go more micro, if at all that is so, PSU banks doing decently okay on a day like this. Do you expect that's one segment which will actually be resilient in this choppy sort of market?
Well, not really, Harsh. I mean, yes, I do agree with Shivang that the banking space has been ever so slightly more resilient than the Nifty itself, or definitely than the broader markets. But if you see, one interesting point is that the call base, which was around the 50,000 mark, which acted as a resistance, has actually now shifted lower to 49,500. Now, perhaps there's a technical reason also why the Bank Nifty is showing resilience, which is while the Nifty has gone below the 20-day moving average yesterday and today now, the Bank Nifty is still flirting with that number. There's still a chance and hope that, it would perhaps hold on to the 49,200 20-day moving average. If that breaks, I think, there could be some near-term pressure in the Bank Nifty as well. But yes, at the moment, it does appear to be slightly more resilient. PSU bank space, as you mentioned, does it look to be more strong? I'm not sure. For a while, I've actually categorized banking space as the large cap and everything else. So to that effect, the HDFC Bank, ICICI, and SBIs of the world still look pretty interesting. SBI is making a double bottom kind of formation near the 720 mark. If that is held, then you could see some sort of a recovery. But no, I wouldn't paint PSU banks as a whole, with one brush, because the likes of Bank of Baroda and a couple of other names haven't really shown that kind of a momentum or strength. Even SBI, for that matter, hasn't done it yet. As long as the 720 mark is protected, there is hope of recovery. But other than that, stick to HDFC and ICICI, and SBI perhaps on further declines from a slightly medium to a long-term perspective will make a good bet.
Interesting one. Shivangi, your picks for this afternoon?
So on my radar first is Tata Consumer, which has been quite resilient. From the last 7 trading sessions, we've seen that it has been respecting 1,010 as a good support level. And in this kind of a market, we've seen that from the FMCG and consumption pack, this has been one of the strongest counters. In fact, it has been a consistent player from the last 6 years. So both a trading and investment pick at this hour looks quite positive, and we are looking at roundabout targets of 1080 in this stock with the support of 1010. And second pick on my radar is Bharti Airtel. From the telecom space, we've seen this is one of the strongest, most resilient. Slightly more volatile than the other stocks, a little high beta, but overall, on a month-on-month basis, it has been following the upward sloping channel. And again, we have to pick out the strength in such kind of a market. So this is one of them. Good open interest activity seen over here, so recommending a buy here. Now, of course, the targets that we're looking at is 1780 levels with a support of 1670 zone.
Okay. Kush, your picks for this afternoon?
I'll start with the common one, the common call between Shivangi and myself. Yesterday on the closing show, we spoke of Bharti as a long trade. It's still holding ground, and seems like great minds think alike and all that, right? So Bharti still a buy on my radar. I'll be at the targets 1750 and 1805, 1640 being the stop loss. On the sell side, I've got LIC. Again, one call that we discussed yesterday, 780 was the target. It was hit today, but along with markets, you saw some recovery in this. But I think that even mild recovery that comes about from that target level, not the absolute closing level, is also an opportunity to sell for further targets of 770. A stop loss here on this one comes close to the 795, 800 mark. So LIC is on the short side, Bharti on the long side.
Okay, so those are two picks from Kush as well. But before we take views or more views, let's quickly go across to Mihika, who's standing by to help us understand, because PSUs as a segment has lost over 8 lakh crore in terms of market cap in 2025. Mihika is joining us to tell us why this wealth erosion is actually taking place. Mihika.
Yeah. So, on an aggregate basis, when you take all the companies that the government of India does have shareholding in 2025 so far, the total market cap loss stands at 8.03 lakh crores. And in percentage formats, that's a 13% fall in 2025. And not one single PSU stock has gained any market capitalization. Now, when you look at the top losers, on top of the list, you have a KIOCL. The market cap loss is at 33%, followed by BAML at 31%, ITI at 30%, RITES at 29%, and the Titagarh Rail at 26%. Amongst the large caps, they've lost around 12.5% of market cap in 2025. The top losers being REC, IRFC, and PFC, and ONGC has lost the least, on the other hand, at 0.8%. When you look at the mid-cap space, a total market cap loss in percentage format stands at 13.5%, and the top market losers are New India Assurance, HPCL, and HUDCO. And Bank of India has lost the least in the mid-cap PSU space at around 1 to 2%. When you look at the small caps, lastly, the government-owned small caps have lost the most, down about 14% in terms of market capitalization. Top losers are your KIOCL, BEML, and ITI, and Gujarat Narmada Valley has lost the least. And lastly, we're going to put it in a perspective of a sector-wise loss in value. The power space tops the list at 15%, followed by aerospace and defense at 14%. Insurance as well, an aggregate loss of 14% in market cap. Banks at 13%. The same we can see in oil and petroleum. And lastly, we have construction at 12%. The one sector that has lost the least on an aggregate basis is metal and mining at 10.5%.
Okay. Thanks so much for that perspective, Mihika. Great breaking down some of these trends, especially on days where you've seen sustained amount of pressure on markets. Sonam, let me come to you. One is the PSU pack. What's the sense at this point? They've corrected, and they've corrected sharply, especially in certain pockets, railways, defense being two of them. Would this be the point where you would take advantage of the correction and buy, because you have a multi-year tailwind on some of these sectors?
Definitely, I think the long-term trend for these stocks definitely remains strong. They have got huge orders that they will fulfill over the next few years. So these are definitely attractive long-term picks. But are we buying these names right now? I don't we are not picking many of the PSU stocks right now. I think while the GDP growth rate and the earning growth rate is on the slowdown path, until unless we see a recovery, the PSU pack might be under a little bit pressures. But yeah, you can start slowly accumulating, because once the uptick comes and once the clarity comes in the market, you will see a recovery from these levels. But we don't have a clear picture on when that happens in our mind.
Sonam, what are you buying at this point? Sorry, very quickly.
I see a lot of movement happening today. Many of our stocks, for example, stocks in the agri segment, diesel locomotives and all that are doing well. We are seeing interest, some in the chemical segment, some in the hospital segment. We bought a few large caps also, like Ultra Cement, Hindalco, Apollo Hospital. Along with that, we have some small caps which we are holding, and we are sort of dealing with the pain of it. But today we are seeing some good upward movement, and I think with the short term recovery, I hope the small cap segment recovers well.
Okay. Okay. Thanks so much for some of those views. Thank you, in fact, Shivangi as well as Sonam, for joining us this afternoon. We'll let you go on that note. Kush, do stay with us, because we're going to have a very quick interview with Sanjeev Verma, President and CEO at Blackbox, to talk to us about, of course, latest numbers and what we can expect going forward as well. Welcome, Mr. Verma. Want to first understand from you, how do you judge, assess Q3, and how does it stack up when you're looking at FY25 full year? And does it gear up well as to how FY26 will also likely play out?
Yeah, I believe we just posted the numbers yesterday.
Yes.
We have delivered 1,502 crores of revenue. The EBITDA looks stronger at 134, and of course the PAT came at all-time highest at 56 crores. The focus for this year has been largely on quality of revenues and improvement of margins, and we have been able to deliver that. For fiscal 25, we are guiding overall revenues in the range of 6,000 odd crore, with an EBITDA meeting our guidance number of 525, and a PAT numbers also in the range of 205 to 210 crores, which is a 23 to 25% growth over previous year in EBITDA, and 49 to 50% growth over PAT. So pretty satisfied from a perspective of margin outlook for this year. The focus on quality of revenues, focus on margin improvement. I think we have a challenge in terms of our revenue growth. Getting into fiscal 26, our strong pipeline that we are seeing now, starting from Q3 onwards, getting into Q4, I think we are well poised to deliver significant revenue growth getting into our fiscal 26, and we're guiding 6,750 to 7,000 crores of revenue in the fiscal. And I believe we have confidence with our pipeline and our customer engagements to be able to deliver that.
You've tapered down a bit, Mr. Verma, with regard to your guidance for FY25 versus earlier. And I'll give you a couple of numbers. Please correct me if I'm wrong again. Earlier, you had guided for around 220 to 250 crore of PAT. You're currently guiding for 205 to 210. And you're also guiding for significant margin uptake going forward. Firstly, where will that margin uptake come from? Where are you cutting back with regard to costs or optimizing? And second, why cut back on PAT for FY25 full year?
So I think we have had an unexpected one-time situation in our PAT for fiscal 25, about 14-15 crores more than we expected, largely coming out of one-time severance costs. So that's what has impacted that lag, about 10 odd crores decline from our earlier guidance. Getting into fiscal 26, the confidence with respect to delivering the PAT largely comes from a growth perspective. We'll continue to focus on quality of revenues and efficiency, but I think the growth momentum itself will allow us to deliver better EBITDA margins and better PAT margins, because we do not expect our operating costs to grow in a linear fashion. So we'll have efficiencies of scale getting into fiscal 26. So the growth of revenues will deliver the guidance that we have given now for fiscal 26.
So I wanted to understand, so growth in terms of top line has been slightly muted, and what you're guiding for in FY26 is a 10% growth. Now, given the opportunities available in the telecom space, would you want to push for a higher growth, and what's the likelihood of that given 5G, etc., in terms of the opportunity being large?
Okay, so I think we, Black Box globally, is a player in the digital infrastructure space. We believe the adoption of AI and end user experience this decade will be driven by build out of massive infrastructure, be it on a network side, 5G, or be it data centers. So we are bullish on that. We are guided about 13 to 15% growth is on the higher side is what we expect. I think we have a large part of our business from projects perspective. So there is a lag from delivering revenue from order book. Our focus this year has been to invest in our sales motion. We have gone verticals and horizontals with respect to how do we address our top 300 customers. We expect a massive uptick in order book, which will deliver 15% of revenue growth. Getting into fiscal 27, we see that momentum to be even larger. So the focus this year is to continue to build our order book, deliver decent growth, and get into the momentum of fiscal 27 and beyond. We have publicly said it to be a $2 billion over the next 4 years' time. And I think every investment now and focus to go towards the next 3-4 years' time to build a momentum with 15% for fiscal 26 and taking it from there.
Okay, thank you so much, Mr. Verma, for joining us, giving us all of that perspective, and wishing you all the very best for Q4 and beyond.
Thank you.
But as broader markets deal with a bit of a correction, we're not exactly in correction territory, but we're nearly there. NDTV Profit spoke to a slew of experts across the mutual fund sector. Here's what they think about investing in a falling market. Hear them out.
It's a bad time to stop an SIP for sure. And honestly, if you're making a 10-year SIP, a 15-year SIP, at least a 10-year SIP, let's not go into 15 years. I don't think it's a horrible time. Don't hold me to that. I will say it's certainly a bad time to stop an SIP if you've been an SIP investor.
Stay put, don't do anything. Don't get swayed by short-term bounces and go overboard. Don't get scared by what is happening and sell at the wrong time. I think it is best to leave the markets on its own for the next maybe 6-7 days. Take a very, very measured and patient view.
Yeah, I would say definitely buy. Okay, it might sound like an equity guy being biased towards equity. I look at about 4 short-term barometers. All of them say that the markets are light. Markets can correct 10%. That's my disclaimer. I wouldn't be surprised if a small cap investor from here on, you can mark my words, in 5 years at least get a compounded return of 12 to 15%.
I think the factors to create a further upleg, I think we are still in the bull market, first of all. And I think the factors, to take us to the next leg upward are pretty much in place. For example, the RBI has started easing on the liquidity front. We are seeing credit growth. We are hoping that credit growth will now come back because of that. The dollar has been very strong, and that's one of the big reasons why FIs have been selling. But now with Trump coming in and making certain announcements, it will remain volatile in the next few weeks, but at least we'll have a clear policy direction. And once the dollar strength, recedes a bit, we should see flows coming back to emerging markets and rest of the markets. So I think in the next few weeks, we'll have a much clearer picture, and the markets should have a reason to go back on the normal growth path.
I think that it's a time to start investing, start nibbling, and our trouble started with the US dollar and the Trump trade, right? What you're seeing now is just last couple of days, there is this, noise which has spread. I respect that, but I think that next 3 to 6 months, if you just stagger your entry, you will get some, good entry point. And I think I completely agree with what Feroz mentioned. And I'm not even a vested party because I don't run a small cap fund, but that's genuinely my view.
entire special package and measures are kind of focus on AI skilling and how to sort of facilitate the AI centers which is existing at this point of time.
Now a center of excellence in artificial intelligence for education will be set up with a total outlay of 500 crores.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Sources telling us is that government is expected to provide a roadmap of the next phase of national monetization pipeline where they are going to set a higher target for the next fiscal onwards.
Building on the success of the first asset monetization plan announced in 2021, the second plan for 2025 to 30 will be launched to plow back capital of 10 lakh crore in new projects.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Well, on to more market voices, and an alpha investor and a large investor, Ravi Dharamshi, spoke to earlier today about the impact of global uncertainty on investors' sentiment, and is this the time to sell or to buy instead? Hear out a slice of that conversation.
Let's agree on one thing. Sure, 6 months back or maybe even 9 months back, odds were not in your favor if you were starting out investing in the markets, and there was a possibility of a correction at any point of time. And we were advising all our clients to not jump in with both feet, take it slowly. However, today, if we can agree that this is a correction and not a major crash, then I think the odds are tremendously in your favor if you're thinking 3, 5, 7 years. Why do we believe that this is just a correction? Because one, there is no crisis happening anywhere, whether it is locally or globally. It's not like we're facing any major issues. So we have seen so many things in the past 20 years, whether it was global financial crisis, 9/11, or demonetization related issues, then NBFC crisis, COVID, wars. So many things have happened. So the reason for this correction was obviously higher valuation, which has corrected now. Now, unless you tell me that we are on the verge of a crisis that's going to break out, I don't believe that valuations need to correct substantially more from here. Now, I'm not trying to predict that today is where the bottom is made and we will see markets rallying from here. No, we'll probably take a lot of time before we form a base and we start moving up. However, the odds are now in your favor if you think 3, 5 years. So that's the viewpoint I wanted to put across. Most of the people don't have the courage or the conviction at this point of time, but this is when one should be building the portfolios.
Yeah, I was seeing the tweet 1 hour ago, right? That cash, courage, conviction, what are you missing? And the tragedy will not be that you missed the correction. Tragedy will be missing out in the next 3, 5, 7 years. Ravi, I think what set the cat amongst the pigeons, at least in terms of, at least when we comment and we as journalists comment on every minute of the market, right? Sometimes it's bad, sometimes it's good. But maybe S. Narain making that comment, right? That even small cap and mid cap funds might take a long time to recover. Now, my question to you is this. Then even if the market were to dip a little bit from here, right? As you said, we don't know when the bottom is made. But would this be a wrong time? I know you don't do mutual funds, but I'm still asking you on behalf of even mutual fund investors and direct investors and PMS investors. Would this be a completely wrong time to stop your investments? That's the point I wanted to drive home. Whether people buy and we see a little bit of a dip, that is secondary, right? First is, because some people might be forced to redeem because they will see this, then there is a decorated CIO talking about how funds may not make money, it may be okay to bolt from these, and they might be tempted to pull money out. I wanted to address that issue first.
So let's put what he has said in context. And I have all the respect for Naren, I think, and he is absolutely right over here to say that as a cohort, small and mid caps are expensive. And from his perspective, from a mutual fund manager's perspective, that is absolutely the right call to make. However, I think calls like stopping your SIPs and calls like going 100% in cash are something that one should take only once a decade. And over there, I disagree that this is that point in time where one should completely stop their SIPs or completely go into 100% cash. No doubt, I think it was par for the course to have a correction like this. Only thing that has probably come as a little bit of surprise for most people is the pace of the last few days correction. And obviously, some of the noises have added fuel to the fire. But regardless, I mean, I don't think if those statements were not made, that markets would not have corrected. Markets would have corrected regardless. And it's silly to be fighting against that. So from that perspective, I disagree on the point that this is the time to go in, completely avoid the cohort of mid and small cap. Now, obviously, I'm talking from the perspective of a multi-cap stock picker. So we don't really believe in looking at the market or segregating the market in large cap, mid cap, small cap. We look at it from the perspective of where are the profit pools going to expand the most, and which is where we would like to invest our money. Now, Indian economy is at a transition phase. We have been, the bulk of the load bearing has been done by the central government capex. Going forward, that might not be the case. It might be a little bit more driven by consumption, a little bit more driven by private sector capex, and a little bit more driven by the real estate cycle. So these are the things that are going to move the economy going forward. So the kind of companies that do well, the kind of sectors that do well will change. But most of the time that we have seen that when these transition happen, usually these companies that are starting out, which become the big beneficiary over a 3-5 year course, are usually small cap and mid cap. I mean, are you saying that you should invest only in the top 100 companies of India? I think that's absolutely a wrong message to take away. It is meant for people, those who, what he's saying is that nobody continues SIP for 20 years. And if you are putting money at this point of time, you will make money only if you hold on for 20 years. And that is why he's saying that you should not do SIP. I don't know. I am not the one to comment on people holding on to SIP for 20 years or no. But do I find opportunities in the small and mid cap, a cohort of 400 companies, which where somebody can grow at 20-25% compounded, and the returns can also be like that with a possibility of a re-rating? I absolutely find those kind of opportunities in the market.
In fact, I have two questions based on that, Ravi. One is based on a tweet that you put out on the 29th of January, wherein you mentioned that in a carnage that we've seen as in the last few weeks, some companies have given blowout numbers, etc., made a new high. So your statement is that your generalization and labeling of companies based on capitalization is my opportunity. I believe what you are trying to say was that if good mid caps and small caps are getting punished just because they are mid caps and small caps, you would want to take advantage of that because they are delivering numbers. Would that be a fair assessment?
That's absolutely correct. Right now, the baby is being thrown out with the bathwater. This is something similar that happened towards the end of March 23, and then suddenly the markets took off. Again, all bets off if there was some kind of crisis to break off from here. But I don't believe that the conditions are ripe for any kind of a crisis, whether it is fiscal crisis, currency crisis. I think government has stepped in at the right time in terms of reigniting an engine of growth, which is consumption. RBI has stepped in at the right moment to provide the required liquidity and the interest rate support, as well as loosen the regulatory noose. And now probably with the kind of move that we have seen in the rupee dollar, I think the free flowing one side depreciation of rupee will also stop. So from that perspective, I think government and RBI pretty much are in the driver's seat and can control the extent of the damage. And I think sooner or later the equity markets will respond to that. So I don't feel that we are on the verge of a crisis. And from that perspective, then this will be as great a time as any. We rallied 4.5 years relentlessly post-COVID. So a correction was par for the course. Index might have corrected 18-20%, and mid caps, small caps would have corrected 25-30% from the peak. Can they correct more? There is no way for me to say that this is where it ends. But the odds are in your favor if your outlook is more than 3 years, 5 years.
Such an important point. The other aspect, Ravi, is this, that a lot of companies on which the valuations were elevated, and I'm no one to say that they were rightly or wrongly elevated, but I'm just saying they were high valuations, and despite good results, companies in the EMS space, companies in energy transition, etc., despite good numbers, the stocks have come off a bit. Now, what typically happens is the market then tends to paint them as villains and may ignore the fact that a lot of these companies are promising, even in the quarter gone by, that they will grow at a very high pace over the course of the next 12 months at least, maybe over the course of the next 3 years. My question to you is, will we, because everybody says that a new bull cycle or a new cycle will have completely new winners, could that be different in specific cases where companies will actually show very strong earnings growth in the next 2, 3, 4 years? And sorry, a long question, Ravi, but the reason I'm asking this to you also is because in our podcast, I distinctly remember you telling me that energy transition is a multi-year theme. The stocks may correct 20-30% and then they become attractive. A lot of them have done that.
Yeah, so I see two different questions over here, and I have a two different response. One is the electronic manufacturing and another is the energy transition. I think from the electronic manufacturing point of view, clearly the valuation had gone a lot of, I would say they were factoring in 3, 4, 5 years out. So they will take time. And in the next cycle, they are likely to underperform, at least for a period of 6, 12, 18 months. After that, can they do well again? Yes, if the story moves on from to components from low level assembly and the valuations become attractive again, yes, we can have one more rally. But I think from the next 12 months point of view, you can consider them because it became part of every portfolio. See, when we bought some of these companies in late 21, early 22, at that point of time, people were very, very skeptical. At that point of time, we were clearly thinking that we will have, Foxtrons and Pegatrons out of our country as well at some point of time, and couple of them have shown great execution. But now at these valuations, even from the peg ratios point of view, PE to growth, I think some of them had become really, really difficult to justify. And now this process of the stocks being owned by a lot of funds and offloading of the same will take time. It doesn't happen overnight. Quarter after quarter, the numbers might still come and the companies might not respond. So I am not in the bull camp on the electronic manufacturing side. Coming to the energy transition, I think energy transition is a far broader trend. Over here, there are many buckets, whether it is biofuels, solar, wind, nuclear, transformers, cables, EVs, hydrogen, many of battery storage. So there are many sub-sectors within that trend which can be beneficiary from time to time. So I won't say that necessarily only one sector represents energy transition. But yes, currently the two sub-sectors that we are bullish on is the solar renewables, and second is the power transformers. Transmission cables, conductors, transformers. So from that perspective, I think those two sectors will continue to do well. I don't think the story has ended. There is a lot of uncertainty regarding what tariffs and what happens to the Inflation Reduction Act in US. That is one of the mainstay of the hypothesis. So any negative over there will surely cause flutter, and it has already caused the uncertainty. However, I do believe that at the end of it, when the dust settles, that you will realize that Inflation Reduction Act has come back in some different form and shape, so something called as Make America Great Again Act or something like that. And those advantages that India derives from being the alternate supply chain provider to China will remain and will sustain. And once that happens, then you'll realize that these companies are still continuing to do well. And that's why that story has not yet ended. It is only a pause at this point of time. So that's my take on the two different trends that you mentioned.
Got it. Ravi, my final question, and that is something that people express that while domestic India will have a lot of positives and there could be a cyclical uptick, emerging markets as an asset class is currently kind of out of favor. Now, you manage global money as well in a large fashion. So I would love to understand from you, could India be the casualty of an avoid EM or sell EM for the time being phenomenon, despite the fact that we've corrected so much? And could that factor lead to a further correction, or do you think that will also come around?
No, I think it has been a trend for the last 15 years. We are talking about it today, but this is post 2009, post global financial crisis. There has been pretty much only one market in the world, which is US. And it has benefited at the expense of every other asset class, whether it is Europe, whether it is emerging markets. Every other market has suffered because US has been doing well. Now, the relative attractiveness of US is going down, and these policies of the new Trump administration are causing a little bit of an issue. So again, I'm no expert on what happens in US, but I do believe that the relative attractiveness of the emerging market as an asset class is absolutely amazing. And maybe the underperformance continues for 6 months, 12 months, but if you're thinking next 5 years, 10 years, this one should not be giving up on emerging markets right now. India has been a collateral damage in that. And I think that going forward, it will be less so. Recently, I had put out a tweet on the extent of FII selling. And if you see, usually if they end up selling about 1% of the market cap, that's when the markets tend to bottom out. So if you had to take the beginning point of this correction as $5 trillion market cap, that means 1% would be $50 billion. And if you see, I think we have already sold close to 30 billion. When I say we, I'm talking about FIIs have already sold almost 30 odd billion dollars. Now, unless, and these are all 1% tends to be, the global financial crisis or COVID, those kind of crisis times. Non-crisis times usually tends to bottom out between 0.5% to 0.7%. So from that perspective, also I believe that we are very close to the peaking out of the FII selling, and if the money comes back to emerging markets for some reason, then India will become a beneficiary again. So no, I don't think this is the time to be getting bearish on emerging markets or India.
Well, a lot of people have been very constructive. If you heard Sunil Singhania earlier today, he mentioned that this, even if you don't believe that this is the time to buy, this is certainly not a time to go out and sell in panic. I must say though, if you pull up the Nifty intraday, I think it's important to revisit that with Kush Bora now. If you pull up the Nifty intraday, we've gyrated and now coming back to breaking even. So, like it or not, 23,000 seems to be that port of call. It was that earlier low of after which the markets rallied in the pre-budget rally, if you will, and then cooled off, but still kind of sacrosanct there. Kush Bora, does today's price action on the Nifty give you some confidence about trading the index on the long side, or is it too early to call?
Too early to call, Neeraj. Just before, or rather at the beginning of the show, my view was that we know that, the sell-off has been extended, especially in the broader markets, but even Nifty, if you see 5 sessions of downturn, 23, 22, 800, that zone previously also acted as a support, some short covering par for the course. In fact, I maintain that, don't be surprised to see another 250, 300 points kind of an up move on the Nifty just on the back of short covering. Just to put a case in point, before we saw this move, from 20 to 800 the last time around, FIIs were close to 90% short. Even after all the covering, they went to as low as just about 83%, and now they're back to 85, 86% short. So that figure, that needle is not moving by a great deal, by a great margin. Until that happens, I am not sure that this market will have a meaningful, sustainable upswing. So the point being, right now the texture of the market remains sell on rise. Even if you get a 200-300 point kind of an up move, 23,300, 23,350 kind of an up move on the Nifty, unless some of the key resistance levels are taken out very convincingly, this will for the near term remain a sell on rise market.
Sell on rise is the key theme at this point, as per Kush. Nirav, if I were to venture a question with regard to ITC and ITC hotels, because of this whole demerger, and now that we've put that firmly behind us in terms of a special situation, how would you play it? Would you at all, would something like an ITC hotels interest you? Because even post the value unlocking, the stock is down over 20%, maybe more, from the highs, despite the value unlocking, in fact, if I can call it that.
Well, yes, if one were to look at the recent results of ITC, then I think what we thought is that it will make more sense to invest in ITC hotels, because the performance of the stock, the particular division, has been quite strong. And we feel that the hotel sector is likely to do well in the near future. The expansion plans are also there in place. So I think we would be tempted to look at ITC hotels as against ITC at this point of time.
And just talking numbers and talking results, what about SAIL, Nirav? It is such a strong set of numbers versus what was anticipated by the street. Stock, of course, didn't react in the morning, but now is reacting up 6% in trade. One, what do you make of the numbers? And two, given everything that's happening in the global arena with regard to tariffs and the like, do you believe that SAIL at this value is reasonable?
It is quite reasonable at this point of time, but unfortunately, sale has been the most sensitive amongst the metal stocks. So, if you see the sensitivity, the beta of the stock, I think it is on the higher side. When the metal stocks fall, I think the major brunt is borne by Steel Authority of India. So, despite the fact that it's reported a very good set of numbers, ideally, I think if one were to take into account the sensitivity factor, then the stock should go up also in a very, very meaningful way, which it has gone up. But I think we will stay away from the stock because of the volatility which comes along with the stock.
Kush, some stocks which are flying in trade. One is a Colte Patil, which is up. And we're seeing a bit of a spike on that even in the last few minutes of trade. The other one is Fino Payment Bank, down 7.5%. Just your quick views on both of those.
So Fino Payment Bank has actually broken, the near and medium term support zones of 270, 265. I think it could actually very well test further lows of about 220 also, going forward. That's the kind of setup it is in, has been selling off for the last 8 odd months. Colte Patil, yes, there were some positive divergences popping up. Not surprised to see the kind of up move that it saw a few sessions ago. But even today, on the back of numbers, I think this is the stock is resisting near this 300 mark. Technically, also a bit of a resistance around that zone for the last 3 to 4 sessions. I think above 300, the stock could pick up momentum. The stop loss on this one, is very clear around the 275 mark, which is a recent low. From a risk reward standpoint, this offers a good, risk reward ratio. So 275 being your stop loss. I think for levels of about 315 to 330, Colte Patil can still be considered, as a long trade, but maintain a strong or a strict stop loss near the 275 mark.
And what about Fino, if at all, Kush? Okay, apologies.
Fino is an avoid.
Got it.
Yeah, Fino is an avoid.
Got it. Okay, fair point. Kush, BTST, STBT strategies?
Today it's going to be an STBT strategy. We did venture a brave one, BTST yesterday.
Yes.
And, that's faring out well, which is on Bharti. But today's, STBT idea is on Marico. All these stocks saw a good up move just before the budget and even during. But after that, ever since, it's been a bit of a sad story for most of these names. So Marico below the 200-day moving average, sustaining below that, which is a bigger concern. So for targets of 620 and 610 with a stop loss around the 640 mark, Marico can be considered as an STBT trade.
Okay. Nirav, if I can come to you with regard to life insurers, because that pocket doing well today, and even some of the financials, in fact. What's your sense? Because it's been a pocket which has seen sustained weakness. It's not something that has seen weakness or has fallen too dramatically over the last month and a half. But it's been sustained weakness maybe over the last, if you look at 3 or 4 years, it's pretty much weak returns. What's the sense at this point? Do you believe that it's some bit of re-rating which is playing out and valuations are coming back to sanity? Or do you believe that there is constructive upside from here on some of these names?
Well, I think they are likely to emerge as short-term defensive plays in such a tough market conditions. So I think HDFC Life or an SBI Life, ICICI Pru, they could be short-term picks from the current levels. And as far as financials are concerned, then I think we like Bajaj Finance at this point of time from a medium-term perspective.
And what about the life insurers? What are charts indicating? And SBI Life is up 2.25%, Kush, and HDFC Life up 1.6 odd percent. So what are charts indicating on some of these names? Because they've come off from the day's high, maybe not in SBI Life, but in HDFC Life. But what's the sense like on charts?
Boy of the insurance space, LIC is actually reeling under pressure, and that's a short call that we initiated yesterday, reiterated that today. So that's the one stock that actually continues to falter, and in the last 3-4 sessions, the volumes have also picked up on the way down. So not a pretty picture on that. Now, as far as the likes of SBI and HDFC Life go, they both of them are taking support near some of the key levels. So I wouldn't really venture a trade just yet. While yes, this is apparent relative strength, in a market like these, if these stocks haven't broken past, some of these strong support zones, then I think this does make a case to buy. Momentum is missing, but I'll take that. But if I have to pick one of the two amongst the HDFC Life and SBI Life of the world, I think it would be SBI Life. Positionally, the stop loss on this one comes close to the 1390 mark. On the way up, you're looking at targets of 1525. Once that is taken out, 1600 also. So slightly better poised SBI Life, but again, momentum's missing. You might just have to wait a bit for the momentum to kick in.
Okay. The other one, which obviously is really, or the other theme which is really making moves, is the fact that you've got IPO lock-ins expiring. One such lock-in is Capital Infra Trust. Now, large lock-in expiring tomorrow, 26%. Nirav, if I can ask you, are these opportunities to buy into some of the names? Because IPOs have obviously not done well, but at the same time, when there's such a large lock-in expiring, there will be pressure on the counter. Something like a Hunasa has been down nearly 60%, not necessarily due to IPO lock-in expiry. But what I'm trying to say is, any significant correction from IPO price, is that an opportunity to actually buy some of these names?
Well, I think as we discussed that there's a lot of froth in the valuations. So I think it is very important to wait and watch for a few quarters to monitor the performance before making an entry into the stock, rather than taking a decision just on the basis of this fall, which could potentially be on account of the anchor expiry.
Okay. Jubilant Food, can we pull up that stock as well? Okay. Stock down now 4%. What's the sense like, Kush, on what are charts indicating?
A bit of downward pressure. The near-term support of 630, 640 rather, being tested and broken. The next move, the next zone for support comes in at 615, 620. I wouldn't really venture a trade just yet. It was showing signs of revival, but again, be it in line with the market, but the recovery hasn't sustained on this one. So for me, it's an avoid. Look at levels of 615, 620 for support. If that does hold on, then it might just give you some sort of a bounce. But other than that, fairly weak.
Okay. And Ashok Leland, Q3 con call suggesting 200 crore of investment in Hinduja Leland Finance in Q4 and a capex of 800 to 1000 crore rupees in FY25. FY26 plans are a work in progress, is what they are suggesting at this point. Nirav, what would you make of this? Because stock up 8% as we speak.
Well, I think it's definitely a positive announcement, and I think as far as the entire auto space is concerned, the commentary has been quite strong. We have seen a move towards a premiumization also, and I think in the commercial vehicle space, I think we were expecting some positive news flow to come in, and I think that's coming from from Ashok Leyland. So I think it is advisable to hold the stock for the time being.
Okay. All right. Now, let's quickly also zoom into what to watch for tomorrow in trade. You have India industrial production data, which will come through. India inflation also for the month of January will come through. US inflation rate will also come through. So you'll have 2-3 big numbers, which will likely impact markets overnight as well as tomorrow. You'll also see the US Fed Chair Powell's testimony. You'll have US crude inventory, as well as some other global macro factors also, like US monthly budget statement, China new loans, China M2 money supply, and Japan PPI. So those are some of the other ones. Earnings, well, Hindalco, Ipca Labs, Manappuram Finance, SJVN, and United Breweries. Keep those names in mind, because some of those will come out with numbers, or all of those will come out with numbers. Last off, corporate action. There's a record date for dividend, and some names on your screen to look out for. Far and few in terms of dividend yield given the stock prices, but those are some names that you'll want to look out for. Share Shares to exit lock-in, you have Capital Infra Trust, 26% to exit lock-in. So you may well want to keep that one on your radar as well. But AstraZeneca, very, very strong numbers. Nirav, quick 30 seconds, your take. What do you make of the whole pharma, chemical, CDMO basket? Positive, negative, any segment that you like, any names that you're looking out for? 30 seconds.
We are very positive on the CDMO space, and I think we feel that there's a good opportunity to look at stocks like Divi's Lab or Piramal Pharma, Strides Pharma Science, etc.
Okay, so those are some names for you. But thanks so much, Nirav, as well as Kush, for joining us this afternoon and giving us all of those views. Always great having you all here. And let's quickly zoom in last minute or so of trade with regard to this Wednesday afternoon. Let's pull up the Nifty 50. Let's see where we're settling in. Absolute flat line, nothing to complain about though. We're well off the day's lows. Let's pull up the intraday chart. In fact, the Nifty Bank trading in the green as we speak. So that's a positive. That's the intraday chart for you. We've clocked a bottom of 22,790 odd, and we're currently sitting well 250 points higher. So, decent positive traction after clocking those lows for the day. So, decent kind of recovery through the day. Let's look at the heat map as well on the Nifty. Try and make what we can of the breadth. The breadth has improved steadily as the day has gone by, and that's one positive. The other positive is all the financials leading the play here today, along with some bit of infra and consumer. So that's how it's playing out. Look at that top rung of stocks that you can see on the top row, and along with it maybe an HUL also participating, a Bharti also participating. So some of those names starting to come to the fore. The heavyweight, something like an HDFC Bank, also decent positive, 0.5% odd higher. What's not doing well? Some auto counters. You have an ITC languishing in trade, and you have a Reliance down 1.5% in trade. So those are some names for you. Let's also switch focus, try and look at the breadth of the market. The advanced decline as has been through the day, but it not as sharp a negative as we saw right at the bottom. So we've somewhere leveled off, and now it's just about 3:2 in terms of declines exceeding advances. We've closed for the day as well. Let's look at the broader markets, and let's look at the Nifty Midcap. The Nifty Midcap Index down around 1/3% thereabouts, well off the day's lows. And the Nifty Small Cap Index also up nearly 450 to 500 points off the day's lows. So positive traction on both of those, 0.7% lower on the Nifty Small Cap Index as well. It's going to be a fascinating week which will unravel on Thursday and Friday. Keen to see how that plays out, because if we are able to hold on to some of these levels, you may well start to see the sentiment start to tilt a little bit more positive, but clearly reflective that that's happening already. Let's look at sectors now. Let's look at all sectors, and within that you're seeing a lot more green on your screen than we have at any point of time this week. PSU Banking Index up nearly 1%, the Nifty Metal up over 0.5% thereabouts, the Nifty Private Bank. So it's all about the financials and the metal stocks which are gaining traction, at least today, among the positives. Even among the negatives, the Realty Index is really lagging, nearly 3% down even today. But outside of that, if I leave that out, not a bad day at all. The auto index is down less than 1%, not bad. The Nifty Pharma index is down around 0.5%. So is the Nifty IT index. Infra is largely flat, and therefore not looking as bad as it did midway through the day today. So clear positive at close. Last off, let's look at the BSE 500 top gainers, top losers, and that's on your screen. Ashok Leyland on the back of numbers. Some other stocks also on the back of numbers, but you're seeing some good traction and big movers given the fact that markets have had a tough couple of days, and you're seeing a bit of a rebound in some names. Prince Pipes down 14%, Bear Crop down 8.5%, you have a Samman Capital down 8%, and those are just some of the many names which are also languishing in trade. So it's not like it's all hunky-dory. There has been pressure in certain select pockets as well, especially where valuations had really run up. But with that, completely out of time on this edition of India Market Close. From Neeraj, myself, everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action on the other side.
regime for individual. In fact, there has been discussion on how to sort of reduce the tax rate.
I am now happy to announce that there will be no income tax payable up to income of 12 lakh rupees.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know.
Hello and welcome to Aero India 2025. The 15th edition of Aero India is seeing participation from over 100 countries and over 900 exhibitors. Over the course, we will be speaking to a lot of companies involved in the aerospace and defense industry. To begin with, Zen Technologies, which is venturing into military hardware. We have HAL, which is looking forward to production of Tejas 1A aircraft, given that GE is now going to supply engines coming March onwards. We have Adani Defense, which is venturing into anti-drone systems in partnership with DRDO, and then SMPP, which is a company which is an IPO-bound company, which is showcasing its protective gears and the work it does in armament. In addition, we'll also have an interaction with Thales International CEO, who Thales has been involved in the Rafale aircraft. They manage the entire avionics for Rafale, and that's how Thales has been participating in the Indian defense sector. They have over 2,200 engineers working in India. So over the course of the show, we will interact with all these companies and bring you an insight from Aero India 2025.
We focus on design and development, and we think of ourselves as an IP defense player. And we started in '93. Now it's almost 31 years. And our journey has been very, very rewarding, especially in the last 10 years. Government has floated policies like IDDM, Indigenous Design, Developed and Manufactured, that is allowing even single vendors. So typically with IP development is, there can't be more than one or two players. So in that case, how do you encourage single vendors? But if you say three vendors, then you are only getting resellers. So the government has introduced this policy, which is encouraging players like us to develop more, reinvest more into the thing. So I think the journey has been very good, especially the last 10 years have been accelerating, and we are doing more and more. In fact, if you see, we have introduced more products during this fair.
Yeah, this is something like a simulator, right?
That's it. It's a firearm simulator. Yeah, it's the infantry weapons specification. Yes. Yeah.
I don't know, mine is better or not, but
so what you'll have to do is just put it on your shoulder.
Yeah.
And if you close your left eye, this is the back side, the foresight, and into the center of the target. So you're already almost there. So this is how quickly you can learn. Because typically in the when you go to the range, you fire and you don't know whether it is, because you have to go to the place and see whether the bullet hole is there or not. Here you can see instant feedback and immediately correct your aim to the...
And it takes care of the distance and everything.
Everything. So you can scale the distance. You can show it little more. So this is 20 meters. Okay. Now let us say it 50 meters. Let us do it.
Okay.
When he's stopping it 1 second. No, just change the distance to 50 meters.
Let me see my...
Yeah. Can you hit
my back side is...
Yeah.
So this 20, it becomes 50 meters basically.
Yeah, now it's equal thing as thing. And we do the software adjustment for the ballistics also. Yeah, the back side, the front side, and the middle of the Ibiza. Not bad. You see, you just missed it, but you're there.
Okay.
On the right side, yeah.
I think I need a lot of practice. I guess the troops are using them.
Oh, yeah. Troops are, for last more than 25 years, their troops have been using. And without sounding very, arrogant, I can say this is the world's best infantry weapons training simulator, by far.
And if I'm not wrong, the simulator business is also the order book is maybe 50% of your order book.
Yeah, almost 60% of our order book is in the simulators. Yeah.
So that's a good sign, right? So what is the kind of order book you're carrying as of now?
So, last I think was about 900 crores, I remember. So 950 crores, yeah. So it is, we will, so that order will be executed in this year and the next year, most of the order, except for the annual maintenance contracts, yeah.
The other thing which is built with you is the anti-drone
system. That's right, yeah.
What do we have here? We've already faced.
So, in addition to anti-drone, we have launched something called as the airborne killer drone system. So this is it's a vertical takeoff. These engines are takes vertical, so doesn't need a runway to land.
Okay.
And then there is a thrust engine that takes it directly. So we can load the loitering munitions here, we can send it. So this is the completely indigenously made system. So this is something that we are unveiling here in the...
How big is the opportunity in the drone system for you?
So, so drones have different kind of applications like surveillance, like, these are attack drones. So depending on what kind of usage that you have, but it's a multi-billion-dollar opportunity. It's a large market, and in armed forces. So now the war is shifting completely from conventional warfare to now drone warfare. We say that the shift is as big as sword fighting to gun fighting now. The drones have become so important, and so till now we were in anti-drone systems, but we saw that in the drone space, the real R&D is not happening. We have seen somebody supplying Chinese component getting caught by the... So those are actually, it's a kind of letdown we have done to the industry. So we thought that we should get into this. We are again, as I told you, we really believe in R&D, completely Indian IP. So we are trying to do this in that direction.
And you think that this will be a big business in the next 1 or 2 years for you?
So I think next year onwards, this will be big business for a drone. Will be very...
Whether this will be taken by the government of India, or you will be exporting these as...
So, definitely government of India we are pushing, but government India is pushing us to export now.
Okay.
So they are saying, listen guys, we will buy, but go and export. If your product is good, that's also authentication that, India is arrived kind of thing. And even the Indian armed forces like when foreign armed forces buy it and use it there. So that's a good plus point that's happening, the support from the Indian government at this point in time for exports.
We have with us Dr. D.K. Sunil, who is the Chairman and Managing Director of HAL. Dr. Sunil, thank you very much for joining us on NDTV Profit. My question is with respect to the street. The street was very anxious about the Tejas project because it was supposed to take off in the last couple of years and it has been delayed. So what is the status there, and what is the kind of timeline now you have?
We have already built the first few aircraft. You saw in the Aero Show that we flew the first 3 Mark 1 Alphas of the 83 order. And the rest of aircraft are also getting built in our plants in Bangalore as well as in Nasik. You are aware that the engine has been found and it was delayed. And now we have confirmation from GE. We have talked to their top management and they are going to deliver 12 engines this year. So I think they had severe supply chain issues and now that's behind us. The first engine is being built. And GE Aviation has assured us that they will be able to deliver these engines to us. So we will be on track to deliver these aircraft.
So there was a target of delivering around 20 to 24 aircraft a year. Where are we and how quickly the ramp up can happen now that the Nasik facility has also stabilized?
See, the capacity for 16 has already been put in place. We've spent more than 500 crores of that. The additional line in Nasik has started. We've invested a lot of money. The first aircraft, we expect it to roll out in March. And in 25-26, this facility also will ramp up to 8 or even more. So by end of 26, we will definitely have this 24 aircraft capacity which we have built.
So, you spoke about the order book. You got 55,000 crores of order in the last 9 months, and now you're looking for the confirmatory orders from on the 97 LCA and 156 LCH. By when do you see that orders to come in, and what is the delivery timeline as you go into it?
We expect these orders to come through maybe in the next 6 months. And delivery timelines, they will kick in 2 years after the contract. But as I have said, we have taken advance action for the LCH as well as the 97 LCA. We have taken board approval and we are buying raw materials and building up the work in progress so that as soon as the orders come in, we will be able to speed up the deliveries much ahead. For example, in the LCH case, we had an order for 15. Which we delivered as soon as the contract was signed because we had all the material in advance.
Sir, if I can have my final question to you on the AMCA thing. I heard you mention that G414 engine can be used for AMCA as well. I think you mentioned that. So is that a possibility that you can extend G414 to AMCA?
There is no confirmation, but I'm only saying that we are going to establish a plant for this. And it is definitely the engine for the LCA Mark II. But perhaps it could be, but we will have to see. But right now it is for the...
When is the Mark II order supposed to come in?
We are in design as of now.
We have with us Ashish Rajvanshi, who's the CEO of Adani Defence and Aerospace. Ashish, congratulations on the launch which you have done, counter-drone system. Tell us something about the journey of Adani Defence, because last 6 years you have scaled up gradually, going into various systems, land, air. So can you take us a journey through?
Yeah, see, the journey actually spun out of the need from the tri-services and the big push by the policymakers on Make in India. In the last 6 years, we have operationalized 6 locations across Kanpur, Gwalior, Hyderabad, Bangalore, and with the recent acquisition of Airworks at Hosur and Kochi.
Yeah.
So what we are doing is focusing on some critical capabilities which are important, including electronic warfare, what we are seeing in the back.
Yeah.
Because every flying object today is a threat. And it's important that from all the way nano drones to mini to micro, we are able to provide a solution which is able to deter and neutralize these threats for Indian Armed Forces, but also the civilian domain.
How big is this opportunity for Adani Defence, not only for the nation, but also as an export market?
Which opportunity? Overall. See, as we discussed previously, as part of this budget, $20 billion of capital acquisition has been announced, of which 75% has been earmarked for the domestic industry. And if you start multiplying some of these numbers, we are talking about a $300 billion market in the next 10 years. It's very important we take a whole of nation approach. This is not about Adani versus Tata versus XYZ. All of us have to come together, create that bottom-up ecosystem, all the way from startups, MSMEs, Tier 1, who are actually working towards a need as required by Indian Armed Forces.
There's something which the armed forces require, and there's something which Adani is also innovating, getting new platforms on board. Can you talk us through what are the new platforms and innovations at work?
The 4 new things which we have showcased as part of the exhibition. One is what you're seeing behind, which is vehicle-mounted anti-drone system. The second is crosshair. So how do you take a surface-to-air missile and put it on every ship, every carrier, and have a multi-turret solution as an air defense available to naval. The third, what we are showcasing is Soldier of the Future. This is not about selling individual arms and ammunitions, but what are the needs of an infantry soldier, all the way from electronic requirements, the so-called thermal sights, and the full package, including the body armor, which can be offered.
How much of investment has gone into the defense in aerospace? I know defense is the big vertical for now.
Already 5,000 crores of investment have already gone into these 6 locations. and we continue to scale our capabilities working with our partners.
And how much are you planning to invest over the next 5 years?
See, putting a number is difficult, but we have already committed around 8,500 crores across each of these areas.
And what about new technologies are you looking at for further new technologies in this area? Because it's an evolving market, new products are coming in.
But see, this is continuous innovation. You need to have the team which is continuously taking you from level 1 to level 2 to level 3. So that's how the teams are currently structured, that how do you continue to innovate and keep giving new technologies and new platforms to the armed forces.
We have with us Ashish Kansal, who is the CEO of SMPP. SMPP is one of the companies which has already received a SEBI approval for IPO. And I think they're awaiting final nod so that they can go ahead with their IPO on Dalal Street. Ashish, first question, you got SEBI approval. What are you waiting for?
I think the paperwork is being done. So as soon as the team is ready, they will go forward with it.
So SMPP is in the defense business. They're into protective gears as well as ammunition. Ashish, you started the entire business with ammunition, right? And then you graduated towards protective gear. Take us through the journey actually.
See, as a company, we stepped into defense when we got into the development of a product called combustible cartridge case for tank and artillery ammunition. This was a replacement for the brass shell, which is used in firing of tank and artillery. And when you fire using a brass shell, the propellant burns, but the brass shell comes back to the gunner.
Yeah.
So the gunner has to handle the hot brass shell, and it also causes a lot of fumes in the environment. It causes an effect on the barrel life. So there were multiple disadvantages with which a concept of combustible cartridge case was developed, wherein this brass shell would be replaced by a combustible cartridge case made using nitrocellulose and other chemicals, such that it would burn within the barrel and not leave any residue, and hence improves the environment and has many other benefits. This is what we started with, and we started with the development of combustible case for 120 mm tank ammunition, further to 125 mm tank ammunition, and then further to 155 large caliber ammunition, artillery.
And how did you graduate yourself to, I would say, to protective gear? But before that, I think you're also now working on the next generation of ammunition as well, which we can see here, and it's part of your expansion project as well, right?
Yes, we are now looking at forward integrating our combustible cases, because since 2019, the government has liberalized the policy and allowed the private industry to participate in the ammunition field as well on a full-fledged basis. So SMPP is today forward integrating its ammunition into a complete ammunition which will be for tank and artillery guns. We're starting with artillery guns because 155 is today one of the most potent weapon systems in the world. It has established itself as the weapon for most of the wars which have been fought recently. And that ammunition is what SMPP is today focusing on developing.
And you have a tie-up with a South African company?
Yes. So we're working with RDM, a South African company, which is helping us out with the technology part, with the plant part, to help set up this world-class facility in India.
This is the capex that you're undertaking in Himachal, right?
Yes. This is, we have a land of 800 acres in Himachal, where we are looking at developing this facility.
And then we have composites, I think, which you provide for aviation as well. And we'll see some of the composites. Yeah. These are the protective composites for the pilots in the helicopter, right?
Yes, so this is the composite, what we have displayed are the composites which goes into our light combat helicopter. So we do this for the light combat helicopter, the light utility helicopter, and many other world helicopter and aircraft programs. These panels stop anywhere from a 7.62 armor-piercing round to a 12.7 anti-aircraft guns. These are how they are designed to protect the pilots, the critical areas of an aircraft, so as to make sure that it is safe, it has a safe flying operation.
And it's designed and manufactured in India, means you have that technology and IPR for this?
Yes, so this is completely in-house developed. The complete ballistic solution is proprietary to SMPP. It was developed by SMPP, and that's the primary design is done by HAL, which is the helicopter manufacturer. And we are
and
done.
you can see those areas marked, right, in that sense.
Yes, so this is what we have shown, a depiction of some of the areas where these protective panels go onto a helicopter.
We are at the Aero India 2025 and we are at Thales. Thales has played an important role in the Dassault Aviation's Racal, which is now part of the Indian Air Force. And joining me is Pascal Sunish, who's the president and CEO of Thales International. Pascal, can take us through the kind of work that we've been doing in India, because you've been there in India for 70 years. So how have you evolved yourself, as well as how do you see the Indian defense ecosystem now?
Well, since the very beginning of our presence in India, we have been focusing on developing competencies and skills in India. In 1953, so that's 72 years ago, we started through a partnership with Bharat Electronics Limited with a technology transfer in the field of radars. So Atmanirbhar Bharat has always been at the heart of our strategy to develop our activities in India. So now, if we have a look at how we approach it today, actually our localization strategy has 3 pillars. The first pillar is Thales itself. We have our own subsidiary in India, fully owned, and we have more than 2,200 people in India, essentially engineers in our engineering centers in Noida and Bangalore. And we are in the process of localizing more and more engineering activities, as well as support and maintenance activities in India. The second pillar is through relationship with strategic partners like Bharat Electronics Limited, like BDL, and we announced a partnership with BDL in the very, very short-range air defense domain at this air show, and many other large companies, public sector or private sector companies. And the third pillar is that we have developed a very comprehensive ecosystem for the Indian supply chain. We have identified many excellent suppliers who have more than 75 Indian companies that work with us, not only for Indian projects, but also are part of the global supply chain of Thales, addressing projects everywhere in the world.
Hello and welcome. Now, the print for inflation as well as industrial production came out a short while back, and it is good news on the inflation front at least. India's retail inflation eased to the lowest in 5 months, and it came in at 4.31% for the month of January on an annual basis. This is compared to a print of 5.22% that we had seen in December. Now, food and beverage inflation eased to about 5.68%. This was compared to 7.7% we'd seen in December, and this was led by vegetable prices, which further cooled to 11.35% compared to a print of 25.6% that we had seen in December. Now, the headline inflation print was also a tad below expectations. It came in, the Bloomberg poll of economists had estimated inflation at about 4.5%, and it came in a tad lower at 4.3%. Now, for more insights on what she's making of this print, I'm joined by Gaura Sengupta, Chief Economist of IDFC First Bank. Gaura, thank you so much for taking time out for us. Gaura? Gaura, I hope I'm audible. Well, while we get her online, we'll quickly have a look at some of the key internals. Now, cereal inflation rose by about 6.24%. This was compared to a print of about 6.5% we had seen in December. Inflation for meat and eggs also was more or less steady compared to the print in December at about 5.25%. Inflation in eggs
eased to 1.27%. This was after rising by about 7% in December. In case of milk as well, inflation was more or less at a similar level as seen in December. Inflation in pulses rose by about 2.6%. This was compared to a rise of about 3.8% that we had seen in December. Clothing and footwear inflation was again very steady at about 2.7%, and that was exactly the print we had seen in December as well. Housing prices too remained steady again. Housing prices were up by about 2.76%. That was compared to a print of about 2.7%, so not much of a change there as well. Clearly, one of the key sort of movers on the inflation front was the easing in vegetable prices. That wasn't entirely on unexpected lines. We were seeing some easing in vegetable prices, and that was a trend that continued for the month of January. Gaura, hi, I hope I'm audible to you now.
Yes, you're audible.
All right, so, what are you making of today's print? It has come in as a positive surprise. We were anyway estimating inflation to ease from the print we had last seen in December. And while it did ease, it eased more than was being estimated, largely led by, again, food and specifically vegetable prices by the looks of it. What are your quick takeaways?
So the moderation is basically led by food and, as you rightly suggested, by vegetable prices. So vegetable prices on a month-on-month basis basically declined sharply. The decline was sharper than expected, hence the headline inflation came a little bit softer than our expectation. The good part about the print is the fact that if you look at even core inflation, though it's slightly up at 3.7, it still remains moderate. If you if you look at core inflation, it's around 3.3%. So very benign core inflation print. Food finally showing substantial easing, especially led by highly volatile vegetables. The fact that the January print has come lower than expectation also indicates that the full year FY25 CPI print will average lower than RBI's estimate of 4.8%. Looking ahead for the month of February, we see the print could be 4%. There's even a chance it could be a little softer than 4% if the decline in vegetable prices that we are seeing in the first 2 weeks of February continues for the full month.
So you did mention that if this trend continues, we might see inflation coming in a tad possibly below the RBI's estimate. Even for the ongoing quarter, the current RBI projection is inflation at about 4.4%. Given the expectation going forward, we will see some undershooting there, right? And is this largely going to continue being led by food or vegetable prices specifically?
So you're right, the Q4 quarter with RBI at 4.4%, we are tracking currently at 4.2. It could be even closer towards the 4%, depending on how food prices evolve. The moderation in inflation will be led by food because it was the food component of CPI which led to the surge. Core throughout this whole period has been very benign, near historical lows. We wouldn't want to see further compression in core because that would be a reflection of softness in growth, because core is demand side inflation. So we do expect inflation moderation to be led by food, which is a more supply side story. Core, on the other hand, we are expecting it to gradually inch up, largely because of base effects. So, but it still stays somewhere around the 4% target core inflation. So again, not too much of an upward move in core inflation, because currently in the economy we have a negative output gap, which is one of the reasons why core remains soft currently at 3.7%.
I do want to understand what this print might mean for monetary policy. We have seen the RBI cut rates by 25 basis points at its last meet, and that was partly because the inflation growth trade-off, especially on the inflation front, did appear, there was some space for the RBI to ease in. So in case of the next policy as well, does this sort of set the stage for another rate cut?
Definitely, we are of the view that you'll have another rate cut in April. This entire cycle of interest rate cuts by the RBI is expected to be shallow. And that's mainly because of the depreciation pressures on the INR. So we do expect another 25 to 50 basis points cut by the RBI this policy, with the 25 basis points penciled in for the April policy. The only reason why we are saying it's a shallow rate cut cycle is because of the tremendous depreciation pressures that you're seeing. So monetary policy will have to balance the need of domestic as well as external factors. And currently, growth, while showing some signs of moderation, is not so weak that it would justify a very sharp cut in interest rates. More important than interest rate cuts is it how much of the interest rate cuts actually get transmitted. Currently, in the current tight liquidity situation, it's very tough for the RBI interest rate cuts to get actually transmitted via the financial system.
All right, thanks a lot for those quick views, Gaura, and like always, pleasure speaking to you. Well, stay tuned to NDTV Profit for our continuing coverage.
tax regime for individual. In fact, there has been discussion on how to sort of reduce the tax rate.
I am now happy to announce that there will be no income tax payable up to income of 12 lakh rupees.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit's research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit's research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Government is considering to increase the custom duty on the imported finished goods ranging from consumer electronics to medical devices.
And to rectify inverted duty structure, I propose to increase the BCD on interactive flat panel display from 10% to 20%.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit's research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit's research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Sources tells NDTV Profit that budget is expected to propose the draft of the new income tax bill. In fact, the draft bill is expected to find a mention in the FM speech on February 1st.
Hi, thanks so much for joining in. We're talking about Your Money Matters on NDTV Profit because we understand that your money matters. Now, in the mutual fund space, there's this propensity of retail investors to look at the past returns, and on the basis of the top performers in any given period of time, you decide which schemes to invest in or not. The thing is, that's not always the best approach to have, particularly when you can see very wild swings in the equity markets in a very short period of time. Take a look at just the last 12 months. In the run-up to September, you had the fag end of the upcycle in equity markets, and then from September onwards to where we stand right now, you've seen significant drawdowns, particularly at the broader end of the spectrum in the equity markets, as a result of which a lot of small cap and mid cap mutual fund schemes have underperformed, and also certain schemes that would have ranked at the top in September are no longer ranking at the top as things stand right now. So we're going to talk about two categories, that's the flexi cap category and the multi cap category, and talk about the winners as they stood in September and the winners as they stand as of now, just to drive home this point, and then we'll talk about how you should go about your own selection. Join me on this conversation. I have Santosh Joseph, who's a founder of Germinate Investor Services, as well as Mrin Agarwal, who's a financial educator and founder of FinSafe India. Thank you so much to the both of you for taking the time. In the advice and in the conversations that you have, is it often the case where people ask you why not this scheme and why that scheme, and often the schemes that they're talking about, Mrin, I'll start with you, the schemes that they're talking about are the top rank based on the last year or 2 years or 3 years. Is that what you always find?
Good evening, Alex. And yes, absolutely. That's what one always finds, that the conversation always seems to be about the funds that are performing well in the last 1 year or who've got recent good performance. And typically, people don't even look beyond 3-year returns. So everything is based upon what is recent performance.
Okay. Santosh, you want to build on that a little bit, because I'm pretty sure in the scheme selection that you do, sometimes the question is why this scheme is performed, say, has got an XIRR of what, 15%, whereas that is 24%. Why not pick that?
So yes, Alex, hi, good afternoon. Mrin was absolutely right. The desire to be in a fund that has got immediate past performance is very high. So there are two kinds of investors. One, they go around and check which are the funds that have done well and wonder whether you're recommending the same, and they ask you why not. The other group of people, after you have kind of discussed with them that these are the funds that you should consider, they go back and see how they have done in the immediate past. So in both the cases, either they're suggesting that to you, or if you suggested, they want to look if it's on the top of the game. So chasing returns is the order of the day. Now, whether they do it after you recommend or before you recommend, asking to be invested into that, it doesn't change.
Talk about the data though. Let's not base this on simply words. Mrin, any data that you might have to suggest that this is indeed the case? Let's first look at flexi caps and then we'll move to multi caps and see how that panned out.
Well, I was just looking at the data as of 30th September. And when you look at the 1-year returns at that point, and I often get questions on a lot of shows that I do on certain funds. Obviously it's because these were right at the top. So when I look at the data, there were funds whose 1-year return was, let's say, showing 60% in the flexi cap category, which have now come down to, let's say, 17, 18%. And as of 31st January, and of course, they don't remain at the top, right? So a lot of questions which are coming in on certain funds which were giving very high performance. And there are categories where the fund performances have also fallen drastically a lot. So when I look at like the top 5 funds as of 30th September and the top 5 funds as of 30th January, I think only two or three of them still remain as the top performers, but there are 2 of them which have gone down drastically, and there are others that have really come.
You want to talk about the names that you're talking about, just to drive home the point, and I'll try and pull that up on the screen as well.
Well, I think if you look at it, Quant Fund, for example, Quant Flexi Cap which was one of the higher performing funds. That one's performance has come down. And if you look at like, Parag Parikh, which is of course an all-time favorite of mine, and I would say for a lot of advisors, and I hear a lot of people also having Parag Parikh as well. And it was not one of the top performers in the September end, but when you look at it now, it is one of the top performers. So yeah, there are many other cases like this as well. Again, where funds were not there, who were not top performers in September, just in a matter of 4 months have come up at the top.
Okay, so 4 months can change quite a bit, and since that high point, Santosh, we're talking about drawdowns of over 15% for the broader markets, right? So obviously schemes that were more aggressive in their allocation towards the broader markets have seen drawdowns. But do you want to add to the data points that Mrin has pointed out, maybe some of the reasons why some of the schemes that sat at the top of the ranking in September have fallen down in January?
Yes, Alex, I think what we could do is we could take, September end being the high point of most of the, top chart busters, and, look at them today towards the end of Jan, or maybe even right now. The numbers are very different from where they were about 3.5, 4 months ago to where they were today. Let's take an example. If you were to look at the flexi cap or even the multi-cap category, there were winners in both the category. And let's take, as on September end, a classic all-weather fund like HDFC Flexi Cap was not there in the list of good performers. But the minute you change the date to and come to early February this year, you suddenly see that HDFC Flexi Cap has come right on top in terms of the way it's performed and the resilience it is shown against a sudden sharp correction in the markets. Likewise, the favorite of last year, like a Quant or even a JM Flexi Cap fund, which did so well up until September, October, right now seems to be also taken so much of the brunt in terms of the correction. So what is the learning over here? The winners up until September, October are not in the top list, and the guys that were missing in that list for maybe the whole of calendar year 24 or till the markets kind of peaked out in September, October, the guys who are not performing then are performing now. Of course, we can discuss their portfolio moves, their cash holding, or their exposure to mid and small cap and the broader markets. But fact is, they have changed, and they're changed in terms of diametrically that the names and the winners are different.
Okay, Mrin, what do you do with this data, with this information then? And ultimately, the bottom line is, how do you choose? Because if you're not choosing the winners in any given period of time, and here we're talking about point to point, so obviously you zoom out, but it's not always available. That data is not always available, particularly if we're talking about the two categories that I've chosen. And maybe that's a little bit of a googly for you to say that because these categories split not too long back, you can't go too far back in terms of the data available. So from that perspective, how do you choose?
So the first question is that what do you do at this point in time if you have these funds and where you're seeing a huge amount of volatility, or you're seeing a big drop and you're feeling concerned about it? I think you need to really evaluate, why did you get into this fund and for how long did you get into this fund for? I think it's also important to go back and look at how this fund has performed at different periods of time. And I'll be honest, Alex, I don't think that individuals can really do this on their own. You certainly need the help of a financial advisor. Now, one of the aspects when you're choosing funds, which investors tend to miss out, is the rolling returns, because that is a better way to look at the consistency of returns, where essentially the returns are taken over a period of time, and you're checking on a daily basis that how the performance has been, and then getting an average. So it's like an average annualized return that you're getting over a long period of time. So first and foremost, since equity is meant for the long term, you would want to look at 7 to 10 year returns, and you would want to look at the rolling returns over there. Again, rolling returns data is not very easily available online for anybody to just go and check. And again, which is why you would need to take the help of an advisor. But this is what I would really suggest, that if you really want to evaluate and do a review of your mutual funds, you really need to go back see what has been the long-term performance of this category. And I know flexi-cap and multi-cap, because of the scheme categorization, the data may not be too long, but even then you might want to go back, look at the consistency of returns that have happened over the years, and then really see whether you want to continue holding this fund or not.
Okay, so let's come to the clincher then, Santosh, which is in these two categories, and these are investor favorites for obvious reasons. Multi-cap has done incredibly well because of the forced allocation in the broader markets, and a lot of these schemes have pivoted over the course of the last several months to have a higher large cap allocation. But given the data that is currently available from your perspective, what are the schemes that you like and why, based on the strategies that they employ?
So, Alex, you're right that both the flexi cap and the multi cap are what we call the diversified equity category. Just the difference between the flexi cap and the multi cap is in the multi cap, you actually have a forced minimum requirement for broader markets, that is mid and small cap, and then the large cap. Whereas in a flexi cap, you do have the cushion given to the fund manager to decide upon the exposure to the broader market and the amount he wants or the lack thereof. Now, essential dipstick would tell you that these funds, if you were to start looking at them from the way they are positioned and the way the exposure to broader market is, it will give you some sort of a macro view about how these funds are positioned. And I think I agree with almost all of what Mrin said in terms of how you have to check on track record and check on rolling returns and check on how these funds have done in the past. But coming back to the way we are right now, I still think that if there's a flexi cap right now that has been more resilient to the market. Now, when you look at that, Parag Parikh stands out. HDFC stands out. Even in as part of such a sharp correction, even a fund like Edelweiss stands out. What are we looking at here? We're looking at how much did you capture on the upside and how much did you fall on the downside? Not all can get all the times right. But if you're able to do better, both on the upside and on the downside, then you have a case for saying, I'd like this fund to be in my portfolio through market cycles. Now, sometimes the data that we are crunching is such a short period since the correction has started. 1.5, 2 months down from here, if the markets are back to all-time highs, then again, you'll have a distortion of data. So we have to be clear. It's also to do with the positioning. It's got little to do with what I think is my favorite right now, but it's got more to do how the fund is positioned. Let's take JM FlexiCap. Had a good exposure to broader markets, outperformed for 2-3 years and came top of the charts with huge margins. Now they have taken a beating, but again, broader markets perform like how just today in the second half of the day you had a recovery. You will notice that again, the funds which are holding more cash or more large cap oriented will tend to dip, and these funds will do well. I think positioning, understanding the positioning along with some sort of track record makes a great case for staying invested.
Okay. Fantastic. So we've given our viewers a bit of a sense as to how to approach this, and ultimately the bottom line, I'm sure both of you will agree, is to not take knee-jerk reactions if you are investing. And when the chips are down, the SIP approach or the SIP approach really allows you to accumulate more units. So that should be the objective, unless there is a very dramatic underperformance. Santosh, Mrin, thanks so much for joining in. As always, pleasure speaking with you.
Thanks, Alex.
Thank you. And with that, it's time for the second part of this conversation, which is what I like to call Wellness Wednesday. We talk about how you should build your wealth through the week, but we don't talk enough about how you should stay healthy. And this is an attempt to do just that. Today, I'd like to talk about diabetes. India has become, or is in the process of becoming, the diabetes capital of the world. There are more young people nowadays that are contracting this disease that has long-term impact on your lifestyle. To talk about how you can identify this, what are the signs and symptoms, and how treatment takes place, I'm joined by Dr. Shweta Budyal, who is endocrinologist, diabetologist at Fortis. Doctor, thanks so much for taking the time. How often do you think that somebody should test for this? What are the early signs? And what should you do if you first contract it?
All right. So how early is something that depends on your risk factors. So if you are obese or overweight, there is no age limit. We should start screening for diabetes even in children if they are overweight or obese. If you have multiple risk factors, like if one of your or both your parents have diabetes, you're sedentary, you're overweight, or there's too much of stress in your life, you have other problems like hypertension or cholesterol problems, which are kind of linked, they are also related to diabetes, or you have had history of gestational diabetes, as in you had temporary diabetes while you were pregnant, you gave birth to a large baby, or you have history of PCOS, then you should start screening maybe from late 20s or early 30s. And I mean, no age is like a bar. If you have more the risk factors, the screening can be started early.
Are there any physical manifestations that could point you to a potential diabetes?
Right. So if you are mildly diabetic and your sugars are not terrible, you may not experience any symptoms, but still the damage related to diabetes or high sugars may be going on in your body. So that's why if you have risk factors, but if you don't have any symptoms, still you need to start screening yourself. And with less number of risk factors, maybe you can screen yourself for once in 2 to 3 years. If you have multiple risk factors, already your sugars have started becoming borderline or pre-diabetic zone, you should screen yourself once in a year's time. And generally, we see the symptoms of diabetes when the sugars are much on higher side, like your HbA1c starts exceeding 8.5%, your sugars start going beyond 200 milligram per DL. That's the time when you may experience the classic symptoms of diabetes, like excessive thirst, feeling fatigued and tired all the time, uh, going to the washroom more often, wounds not healing, itching on your body, or urinary or genital infections, unexplained weight loss. So these are all symptoms that we see when patients are severely hyperglycemic or when their sugars are quite high.
So, okay, so doctor, what we learn in the school books is about two types of diabetes. One is hereditary and one is not. And we've primarily been talking about the second type. If you are pre-diabetic, or if you've pointed out, as you pointed out, if you found out too late and you are properly diabetic, what should your response be? How do you treat this?
All right. So first thing is, like, do not panic. Diabetes is treatable condition. And if we keep the sugars under control, we can very successfully prevent all the complications. Second, if you have recent onset diabetes and you make a lot of lifestyle changes, lose a lot of weight, your diabetes may go actually into remission. You may not require medications, at least in the beginning. So the first and the most important thing is you have to see a doctor, an endocrinologist or a diabetes specialist, and understand what are the drivers in your body that are making you go into hyperglycemia or high sugars. And second factor is, like, patients who have like very high sugars, they have symptoms, or sugars are likely to cause problems if they are not started on medicines. Those patients should start taking medications. And as I said, the most important treatment for diabetes is lifestyle intervention. So changes in your diet, physical activity, weight, stress management, adequate amount of good quality sleep, all that can help you to get your sugars down with less number of medications, or even without medications after a while, at least in the beginning. So I think it's most important that you consult a doctor, follow the advice, go to a registered dietitian on regular interval, and look after all these factors.
Okay. A few myths I would like you to bust. One myth, of course, is that if you have diabetes, that means that you shut off sweets completely. Is that incorrect? And two, is it costly to manage diabetes, and is it a strain on the pocket?
Right. So when you are a diabetic, you are carbohydrate intolerant. So either you are making less insulin, or whatever insulin you make, it's not working efficiently. So obviously your sugars, the tolerance to any sweets or tolerance to any food items which is going to get converted into glucose quickly is going to be less. So ideally, the diabetic patient should stay away from refined sugars or refined carbohydrates. But if your sugars are well controlled, you have lost weight, obviously your carbohydrate tolerance will again be like little better. In that situation, it is okay to have like around 1 to 2 spoons of sugar per day. But often we see that whenever we allow patients to have a bit of sugars, they end up going a little overboard. So we refrain from giving that advice, but it is okay to have like up to 2 spoons of sugar per day should be fine. But you should harp more on getting more amount of complex carbohydrates and proteins and fibers in your diet.
What are examples of easily available complex carbohydrates?
Complex carbohydrates are whole grains, like your wheat or even your millets. Millets are better than wheat in most of the patients that we see. So the jawar, bajra, nachni, all these things, millets, kodu millets, there are a variety of millets, region specific in India.
Yeah,
so
and would you say, okay, and would you say that it's costly to manage diabetes, doctor?
Yes, I mean, the cost of treating, I mean, most of the patients with diabetes also have other comorbidities like hypertension, cholesterol problems. Many of them already have gotten into complications like heart issues, past history of strokes. As a result, they have to be on multiple medications. So on an average, a patient with type 2 diabetes who has multiple other problems may end up spending around 3,000 to 5,000 rupees on the medications. Some of the newer medications, when they are in a patented step or stage, the medicines may be expensive. Like for example, if we talk about a molecule called semaglutide, the monthly cost can easily go up to 9,000 or 10,000 rupees.
A month, right?
9 to 10,000 per month.
Yeah.
So the cost really depends on the number of medicines that you're taking, what kind of medicines you take, and how intensively your monitoring has to be done. There are patients who are on multiple daily injections of insulin, and they have to monitor their sugars very rigorously, multiple times daily with a glucometer or continuous glucose monitoring system. So all this adds to the cost. But what we should take into account is that in long run, when we manage diabetes well, all these treatments are cost effective. Like suppose if we don't take care of all these things, and a patient lands up with a complication or any severe problem and he has to get hospitalized, the cost is going to be way more. If one hospitalization and cost you the drugs worth 1 year's time. So if we can prevent like hospitalization or even like poor quality of life, disability, in long run, these medications are actually cost effective.
True. So therefore, the point that you made about early identification becomes very, very important. Doctor, thanks so much for joining me today and for explaining the details of this very, very important subject. Thank you so much for joining me.
Thank you so much.
All right, that brings us to the end of this edition of Your Money Matters. Thanks so much for tuning in. This is NDTV Profit.
This entire special package and measures are kind of focused on AI skilling and how to sort of facilitate the AI centers which is existing at this point of time.
Now a center of excellence in artificial intelligence for education will be set up with a total outlay of 500 crores.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Sources telling us is that government is expected to provide a roadmap of the next phase of national monetization pipeline, where they are going to set a higher target for the next fiscal onwards.
Building on the success of the first asset monetization plan announced in 2021, the second plan for 2025 to 30 will be launched to plow back capital of 10 lakh crore in new projects.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Welcome, you're watching The Big Question. I'm Tamanna Inamdar. It's a meeting that could define the future of Indo-US relations, as Prime Minister Modi is all set to meet US President Donald Trump in Washington on February 13th. The stakes are higher than ever. Trade tensions, defense partnership, immigration policies and strategic alignments, every issue on the table has the potential to reshape global equations. But with Trump 2.0 doubling down on his America First agenda, India will have to navigate a far more transactional and unpredictable White House to maintain its Make in India stance. At the center of the discussions is trade. Trump wants greater market access for American goods and wants lower tariffs on American goods imported by India. In return, India is looking for tariff rollbacks and regulatory clarity in sectors like IT, services and pharmaceuticals. But Trump is known for playing hardball. Will India have to make unexpected concessions to secure a favorable deal? Can we escape tariffs? Defense cooperation is another crucial bargaining point. India wants access to advanced US military technology, while the US seeks greater Indian defense purchases and stronger security commitments. Talk around fighter jet, engine production, co-developing combat vehicles and deepening military alliances will be closely watched. But the most sensitive negotiation may be on immigration. The recent deportation of over 100 Indian nationals from the US has heightened concerns, and Modi is expected to push for stronger assurances on H-1B visas, an issue that directly affects India's tech workforce. However, Trump's crackdown on illegal immigration and stricter visa policies remains a non-negotiable for his administration. So will India be able to strike a balanced agreement? Will immigration be a major sticking point? These are some of the questions we are talking about today. Why the Modi-Trump meet is so crucial and so high stakes. Let's start with the conversation. Harshvardhan Shringla, former Foreign Secretary of India, first on my show. Mr. Shringla, thank you so much for your time right here on The Big Question. Just the fact that Prime Minister Modi will be the fourth foreign leader to meet President Trump since he took over just a few weeks ago, what does that tell us about how much the United States is prioritizing its relationship with India right now?
So Prime Minister Modi has been in touch with President Trump. If you recall that soon after he won the elections, Prime Minister Modi spoke to President Trump. Soon after he took over office on the 20th of January, Prime Minister Modi spoke to him on the 27th of January. So I think from that perspective, there has already been some exchanges between the two leaders. But of course, this is Prime Minister Modi's first visit under the Trump 2.0. And it is, from that perspective, important. It is also, as you correctly pointed out, one of the first international or foreign visitors that President Trump will be receiving in his second term in office. And that is also significant because it indicates a priority in terms of, the global sort of outreach that President Trump would wish to have. And an in-person meeting is definitely very important when it comes to, the connect between leaders. Both President Trump and Prime Minister Modi attach a lot of importance to that one-to-one relationship that would set the momentum for relations between them and their global partners. So I think an early visit is an indication of the high priority that both countries attach to the relationship, and the fact that both the leaders have the desire to get down to business as early as possible, reflecting the relationship.
I think, Mr. Shringla, what also becomes crucial is the timing, and we've been speaking about this even from the perspective of equity investors. People in the markets have been watching this visit very, very closely because of the big fear on tariffs. And this meeting is taking place even as reciprocal tariffs are supposed to come into place in the United States. I'm just wondering why this becomes crucial, and on this reciprocal tariff business and this aspect, how does India stand vis-a-vis a lot of other nations that are now said to be impacted from President Trump's non-negotiable that we will tax you as much as you tax us?
Well, the issue of trade relationships is important because India is one of the United States' larger partners, but the US is India's largest export destination also. So from that perspective, that trade relationship is vital to both countries. President Trump has had a fairly, I would say, proactive first few weeks in office. He has increased tariffs, 25% tariffs on, or 10% tariffs on all Chinese imports. This is in addition to the 25% he levied in 2019. He started off by imposing tariffs on Canada and Mexico as well. He's threatening tariffs on the EU. But what is important is that he's levied global tariffs on steel and aluminium, which also affects us. So in that context, the visit is important because you need to have the leaders talking to each other on how they would, manage that expectation from the US side that there should be a more reciprocal arrangement with regard to tariffs, and how the two sides can again collaborate to make it a win-win situation when it comes to trade, investments, technology, and everything on the economic side of the relationship.
In your view, sir, how much does the personal camaraderie between the two leaders matter? Looking at what lessons we're learning from Trump 1.0, because clearly the leaders got along very well even then, and from the transcripts we're hearing and seeing and the reportage on their initial phone call, that camaraderie seems to have continued. We saw that in Namaste Trump, Howdy Modi, all of that playing through. How much does that make India's case even stronger?
So in Trump 1.0, by the end of that term of office of President Trump, I think the two leaders had established a very good rapport, very good chemistry, which I was able to witness firsthand. And I think that made a lot of difference when it came to the two leaders speaking to each other and coming to certain conclusions that were positive for the relationship. And I think I have no doubt that personal chemistry will again click under Trump 2.0. There is every indication that the two leaders, attach the highest importance to that relationship. And Prime Minister Modi is going there early in President Trump's second, term in office, is an indication, as I said, of the importance both leaders attach to that relationship. And I'm sure that they will be able to discuss both areas of convergence and areas where we differ in a manner that would be positive to the relationship, whether it comes to trade and tariffs, whether it comes to technology, defense, or immigration, or anything that is in the form of issues that the relationship has to offer. But don't forget that the meeting is not just about specific bilateral issues. I think the two leaders will discuss global and regional issues of interest. And I think their perspectives and how to dovetail their policies that could be complementary would be very important also in that discussion.
All right. Thank you so much, Mr. Shringla, for speaking with us. That was former Foreign Secretary of India, Harshvardhan Shringla. To speak on this further, I'm joined now by Taranjit Singh Sandhu, former Ambassador of India to the United States, and Nicholas Nugent, British journalist and former BBC editor, London. Welcome to both of you, and thank you so much for your time. Ambassador Sandhu, let me start with you. It's interesting the way we here in India are looking at the Trump presidency compared to many other nations across the world who are looking at the Trump presidency maybe with trepidation, sometimes with fear. We here are looking at it quite positively. We've largely come to the conclusion that the Trump presidency is good from an Indian perspective. Do you share that view?
I think, Tamanna, if you look at our earlier experience in 2014, in 2017, in 2020, and now it's 2025, I think the India-US relationship has transformed into a partnership, and there is a certain amount of confidence. Look, there are going to be challenges, there is no doubt, but that also provides opportunities.
Okay. In terms of those challenges, and let me come to those challenges first, a follow-up for you, Ambassador Sandhu. How big a challenge are these tariff statements, if at all, from an Indian perspective?
So look, certainly there is a challenge, and this is not the first time. Of course, he has been speaking much more in detail, but there is an element which is often underlined, and it certainly has an impact. That is what you say is a climate of uncertainty globally. Now, in my understanding, uncertainty or unpredictability is a strategy. And there is a complicated global reality today. There are problems of economy, there's problem in Ukraine, Russia, you see, Middle East, China, etc., etc. So he's basically, if you take a look and if you take a serious look at President Trump 2.0, he has got elected on a domestic agenda. And therefore, his focus is essentially domestic. And if you look at any of his orders, any of his statements, you can see impact of it in domestic routes.
Nicholas Nugent also with us. I wonder how you see the India-US relationship right now, Mr. Nugent, and with the context that Prime Minister Modi will be the fourth leader to visit the US and visit the White House after Trump has come back to power in the first few weeks, and this meeting coming in at a very crucial time when the conversation is about reciprocal tariffs, and we're still waiting to see what those reciprocal tariffs look like for various nations and across product classes.
Well, I think in a way you answered part of that question yourself by pointing out, as I was going to, that he is the fourth leader to meet the new American president. And I think that's quite an honor. I mean, no European leader, for example, has met Mr. Trump so far since he took office, which is less than a month ago. So to be getting in there after three and a half weeks is really quite distinguished. And I would point out that two of the leaders, that's Mr. Modi, Prime Minister Modi, and the Prime Minister of Japan, are members of the quadrilateral grouping with America. I'll expect the fourth member, Australia, to come along soon. And I think that's one of the issues that will be discussed. I know we're not allowed to call the quadrilateral an alliance. It's called a partnership, but it's very definitely a symbol of those countries' foreign policy, in particular towards China. So I'm sure that'll be high on the agenda. But let me add a bit that I think not only is he the fourth leader, but I think the visit is being watched far wider than in India, because we are all trying to gauge Mr. Trump, version 2, as you're putting it, because one thing that hasn't changed is unpredictability. We don't quite know what Mr. Trump stands for, but what is quite clear after 3.5 weeks is that foreign policy is very high on his priorities, and especially perhaps trying to stop the two raging wars that are going on. And I think the timing of Mr. Modi's visit is absolutely crucial. And I'm sure that the fact that Mr. Modi and indeed India have a close relationship with Russia will be perhaps dominate the conversation between the two leaders.
Will Russia dominate the conversation? Ambassador Sandhu, I'd like your take on this, because you were, of course, ambassador to the US during the Biden years. And I'm just wondering, what were the sticking points then in that equation and in that, sort of chemistry between the two leaders? Do you see any of those now translating or following through to the Trump administration?
So, Tamanna, just to clarify to you, I was also the ambassador during the last 1 year of President Trump.
Yes.
And I brought him in.
You've seen both, yes.
Yeah, I had brought him in here in February of 2020 on that visit, which everybody noticed. But I'm going to slightly disagree with Nick. The relationship, as I said, is much wider. And as Prime Minister himself has indicated, there are going to be 5 broad areas. So yes, trade is important. And I think the most critical aspect there, which we are reading about, is essentially the imbalance or the surplus of 45 billion. Compared to many others, it's not that much. But I think here is where is the opportunity. You know that President Trump prides himself as a deal maker, as a pragmatic deal maker. So there are going to be issues regarding tariffs. But there is also an issue to access to US market for many of the Indian companies. So a deal, a possibility of cutting a deal opens up here. Then there is also the issue of defense. Look, US has emerged as an important pillar for Indian defense products. and there is a requirement for top of the line products. And when I say top of the line, I mean top of the line, and certainly favorable terms. And what we talk of is tech transfer, co-production, and of course, operational and logistic cooperation between the two is already happening. So this would get increased much more. You are aware that there is a 10-year agreement, framework agreement, which was first signed in 2005. Then it got extended in 2015. Now, 2025 is the time when that will be reviewed. So this time again, there is an opportunity to make a more ambitious framework agreement. And then energy. You know, India is an important importer of hydrocarbons. And you know, US is a major producer today, and it's also becoming a major exporter. Now, there is a great room for collaboration here. Now, that certainly is going to be part of the discussion. And sub B of that is nuclear power. You know that SMR is much in vacancy these days. I mean, it's been written already in the statement. So that's also going to be one area that will be discussed. And finally, I know it's extending, but I want to tell you that that room is going to be full of a lot of discussions and technology and parts of technology. Look, I said IT, new emerging technologies, cyber, etc., you know, even startups come in that. And finally, the supply chain resilience. Please remember that it was Trump 1.0 when supply chain resilience came into focus because of the COVID. So that's also going to be part of the discussion. So I will say that broadly, these 5 areas are going to be important.
You know, I'm wondering, and of course the 5 areas you've mentioned are absolutely right, but I just want to take this question to Nicholas Nugent. I'm just wondering how the India-US relationship should be seen in the context of Trump and his focus on China. So now, it's very clear that as far as AI race, DeepSeek is concerned, there is an issue. There are already one set of tariffs on China. But then look at the solution he got in for TikTok. How do you see that equation forming? And this thought that India is the more reliable default partner when it comes to the US shoring up against China's growing reach?
Well, I'm not sure I see it like that. You're rather suggesting that it's China or India and who predominates in American thinking. And I don't think there's any question there that the relationship is considerably closer with India than with China. But I don't think this is an exercise in ganging up because India perhaps is solving its differences with China. I speak cautiously. I spend a lot of time in India, but the ambassador would know far more about the status of India's current relations with China. And every indication is that Mr. Trump wants to solve relations with China, or improve relations, I should say, because it is, of course, an important trading partner. And to come back to tariffs, the subject of tariffs, I mean, what we're seeing on the tariff threat so far is that Mr. Trump's using that to solve other issues, which is why he appears to have backpedaled a bit on Canada and Mexico once he got concessions from them. So I rather suspect the same will be true of China. So tariffs is not purely an economic issue. It's a political issue for the president to try to ease concessions. Now, how that'll work with India, I don't know. I can't speculate. I'm very interested in what the ambassador said. I wonder if he helped write the briefing paper for Mr. Modi's visit. But I would like to ask the ambassador, don't you think India's purchase of oil from Russia will be on the agenda? Because that's something that is rather upsetting shall we call it the Western Alliance, those who are more sympathetic to Ukraine than to Russia. And I think, personally, I think we're going to get moves on the Russia-Ukraine issue within the next few days. That's another reason why Mr. Modi's visit at this time is absolutely critical, because if Mr. Trump found Mr. Modi sympathetic to his efforts to solve the issue, that is key. You know, India now matters quite a lot on the international stage, and that's why this meeting is so important.
I agree, absolutely important. But let me take that question to Ambassador Sandhu. With the point of view that I sat down recently with the Union Minister for Oil, Hardeep Puri, and I asked the Minister this question, and he was very clear that we have reduced drastically the amount of oil coming in from Russia. There is a lot more supply than demand. But Ambassador Sandhu, is this a sticking point? Is Ukraine, Russia and India's purchases of oil a sticking point, and do you expect that to come out during the meeting?
Look, I can understand Nick's questioning. Let me first answer on the Russia front. Look, you have already got it from the oil minister, what aspects, how it's going. But I just want to draw your and Nick's attention. I'm sure you would have observed on this Sunday, there was an interview by the US NSA, Mike Waltz. And in that, he mentioned about a forthcoming visit of Prime Minister Modi. And he also mentioned about India playing a role in Russia-Ukraine crisis. So it points towards that. I want to say something on China, because look, China is going to be a very interesting issue in US. And 3 points I want to mention here. One, do keep in mind that the strategic team of President Trump or Trump 2.0 are certainly known for their positions on China. So whether you look at NSA or you look at the new Secretary of State and some of the other experts there, so that's one pressure which will come in. On the second side, and here is a little new dimension. President Trump always remembers about the election in 2020. And one of the reasons why it got so complicated was because of COVID. And you know whom he holds responsible for COVID. I think even in the current, if you see the latest statements by CIA chief and others, I think that points to that. Finally, there is also going to be a lot of commercial pressure. And let me not in any way, and that in fact points to the TikTok issue. And also you are aware that some of the prominent businessmen are very keen that relationship with China should be normalized. So all these pressures are going to come in on him. But as far as India and United States are concerned, look, as Nick already mentioned about, that Quad and what kind of issues Quad has touched upon and the focus which Quad got. In fact, one of the first meetings which Secretary of State had was with External Affairs Minister and the other Quad partners. So again, this is going to be something which needs to be watched, and I'm sure experts like Nick will watch it closely.
Yes.
There are going to be competing pressures on President Trump.
Right.
So let's see where it goes.
Well, we should talk again once it's clear what's on the agenda and once this meeting is concluded. But for now, thank you so much to both of you for joining us on this episode of The Big Question, where we're setting the stage for what will definitely be a very, very crucial meet. Not just because of the prominence of the two nations, the leaders, but also because of the timing and how all stakeholders are watching it so closely. Well, that's all the time we have. Thank you so much for joining us, but we'll be back tomorrow, same time, same place.
regime for individual. In fact, there has been discussion on how to sort of reduce the tax rate.
I am now happy to announce that there will be no income tax payable up to income of 12 lakh rupees.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Government is considering to increase the custom duty on the imported finished goods ranging from consumer electronics to medical devices.
And to rectify inverted duty structure, I propose to increase the BCD on interactive flat panel display from 10% to 20%.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy?
Hello and welcome to this Wednesday edition of the World Report. I'm Arjun Savar Mahindran. Let's take a look at what's making headlines around the world. PM Narendra Modi on Tuesday said that this is the right time, in fact, for businesses to come to India as the country works towards the goal of becoming Viksit Bharat by 2047. Now, this while providing a robust business-friendly environment and policy continuity. Addressing the 14th India-France CEO Forum in Paris, PM Modi said that the meeting is a confluence of the best minds from India and France. Meanwhile, Google CEO Sundar Pichai highlighted the incredible opportunities that AI will bring to India following his meeting with PM Modi on the sidelines, in fact, of the AI Action Summit in Paris. Meanwhile, the UK and US have not signed an international agreement on AI at the global summit. Now, the statement signed by dozens of countries, including France, China, and India, pledges an open, inclusive, and ethical approach to the technology's development. In a brief statement, the UK government said it had not, in fact, been able to add its name to it because of concerns about national security and global governance. Earlier, US Vice President J.D. Vance told delegates in Paris that too much regulation of AI could kill a transformative industry just as it's taking off. Listen in.
Loss of jobs is AI's most feared disruption. But history has shown that work does not disappear due to technology. Its nature changes and new types of jobs are created. Friends, India has successfully built a digital public infrastructure for over 1.4 billion people at a very low cost. And we have made digital commerce democratic and accessible to all. This vision is the foundation of India's national AI mission. We have one of the world's largest AI talent pools. India is building its own large language model considering our diversity.
After France, the PM will leave for the United States. He is on a key two-day US visit starting Wednesday and is expected to, in fact, propose tariff cuts and increased energy and defense imports during a meeting with US President Donald Trump. PM Modi keen to avert a potential trade war and boost trade ties after Trump threatened reciprocal tariffs on many countries.
We have with us NDTV's Nikuj Garg joining us all the way from Washington. Nikuj, Prime Minister Modi is the fourth world leader to beat the president in his second innings. How significant is that? And what does that really go on to say about the relationship between India and the United States?
Well, yes, that proposition certainly is reflective of the not only the strength that the Indo-US relationship carries, but also the fact that how consequential this relationship has become for the entire Capitol Hill. Remember, in the last 2 decades or so, there has not been a single administration on the Capitol Hill in the White House that has thought any lightly of the Indo-US relationship. Almost all the administrations, right from the time Prime Minister Vajpayee took those nano steps of transforming the landscape of Indo-US relationship, have been extremely serious about the nature of this relationship, about the consequence of this relationship. And look, who has President Trump been meeting since the time? It's not been not been a month since he has been inaugurated, and he has been meeting allies, old American allies like Jordan, like Egypt, like Israel, and all of them in under a contingency. So that's a contingency plan of the administration where there is a situation contingent upon the United States, contingent upon the president himself. But when it comes to India, there is no contingency here. It's just the sheer strength of the relationship and the personal bonhomie. Let's not overlook the fact of the personal rapport and the personal bonhomie between President Trump and Prime Minister Modi that brings the strength to this relationship, the additional strength. In fact, I was talking to a ranking diplomat yesterday in Washington, D.C., and he told me that he does not remember a single occasion, which means that panning back to somewhere around 90s, he does not remember a single occasion where the apex of the political Indian leadership has been invited. And look, all these meetings do not happen at the behest of someone. These happen at the invitation of the host country, particularly when that country happens to be the United States of America. So, in the 30 years or so that he could recall, that top-ranking diplomat on the DC, he says that he does not recall a single occasion when the apex of the Indian political leadership has been invited to Washington, D.C., to the White House so very quickly. So quite clearly, it reflects the strength of the relationship. It reflects the personal chemistry between the two leadership. It reflects the consequential nature of this relationship, Indo-US relationship between the two most consequential democracies in the world, in the global arena. So the entire gamut of that relationship and its strength can certainly not be overlooked.
Israel's Prime Minister Benjamin Netanyahu has said that the Gaza ceasefire will end if Hamas does not return Israeli hostages by midday on Saturday. Now, this comes after Hamas said it would postpone Saturday's planned release, accusing Israel of, in fact, violating the terms of the ceasefire. Benjamin Netanyahu warned of a return to intense fighting and said that his cabinet were in unanimous agreement following a 4-hour meeting. He said, and I quote here, all expressed outrage at the shocking situation of our 3 hostages who were released last Saturday. Listen in.
ההחלטה שהעברתי בקבינט פה אחד היא זאת. אם חמאס לא יחזיר את חטופינו עד שבת בצהריים, הפסקת האש תיפסק וצה"ל יחזור ללחימה עצימה עד להכרעה סופית של החמאס.
Israeli Prime Minister Benjamin Netanyahu is threatening to call off the ceasefire with Hamas. Netanyahu says he will resume the war in the Gaza Strip if Hamas does not follow through on a promised release of hostages this Saturday. His tough words come after Hamas announced it will not free the hostages. It accuses Israel of violating the ceasefire. It says Israel is obligated to allow more badly needed aid into the territory. Netanyahu's tough position comes after President Donald Trump called on Hamas to release all remaining hostages by Saturday. That's over 70 people. Now, this demand goes well beyond the contours of the current phase of the ceasefire, and it's unlikely that Hamas could meet this deadline. But the tough words appear to be emboldening the Israeli leader. Remember, Netanyahu was at the White House last week where he had a warm meeting with President Trump. Now, Saturday's a few days off. That gives time for international mediators to work behind-the-scenes diplomacy in hopes of restoring this ceasefire. But in the meantime, Netanyahu has ordered the Israeli military to beef up troops in and around Gaza. A resumption of the war would be disastrous for the people of Gaza, who are only beginning to recover from 15 months of heavy fighting. It also would spell trouble for the families of remaining Israeli hostages. They are calling on Netanyahu to stick with the ceasefire until all hostages come home. So Netanyahu in the coming days will face heavy pressure from multiple directions and have some very difficult decisions to make.
Jordan's King Abdullah II, in fact, told Donald Trump on Tuesday that his country would take in some 2,000 sick children from war-torn Gaza enclave. However, he pushed back against the US president's plan, in fact, to take over the Palestinian territory and send its population into exile. However, he told Trump that Egypt was working on a plan for how countries in the region could, quote-unquote, work with Trump on the proposal. The Jordanian monarch also appeared to offer a sweetener to Trump, who had just the day before the visit floated the possibility of halting US aid to Jordan if it did not, in fact, take refugees. Listen in.
We were just in the Oval Office with President Trump and the King of Jordan, and they were talking about the future of the Gaza Strip and the ceasefire deal with Israel and Hamas. President Trump says he does not think Hamas will comply with terms of the ceasefire deal and that all bets are off starting Saturday at noon. The pressure is on Hamas to release the remaining hostages in order to keep the ceasefire operational, and Israel has signaled it's ready to restart hostilities if they don't get the hostages out.
Ukraine will offer to swap territory with Russia in any potential peace negotiations, President Volodymyr Zelensky has said in an interview on Tuesday. Now, he added that Europe alone would not be able to shoulder Kiev's war effort. According to reports, Zelensky will meet U.S. Vice President J.D. Vance on Friday at the Munich Security Conference as Washington pushes for an end to the nearly 3-year war with Russia. Now, Vance has been a frequent critic, in fact, of US support that has been vital for Ukraine's war effort. Listen. Meanwhile, the US Treasury Secretary Scott Bessent will travel to Ukraine this week, Donald Trump wrote in a social media post on Tuesday. Trump said that Bessent, in fact, will meet with Zelensky and suggested that the two leaders could discuss pathways to ending the conflict. US President Donald Trump and ally and advisor Elon Musk spoke to reporters in the Oval Office Tuesday afternoon, defending slashing of federal government's programs and employees under Musk's Doge program and insisting that they are quote-unquote maximally transparent in their efforts. In a rare question and answer session between Musk and reporters, Musk insisted he is not orchestrating a hostile takeover of the government, but in fact, instead, is giving the voters what they asked for to begin with. Asked if he is in effect policing himself as he has a number of government contracts, Musk maintained there has never been an organization that has been more transparent than the Doge organization, and that the public can see for itself whether there are conflicts of interest. Now listen in to what Musk said.
There are good people who are in the federal bureaucracy, but you can't have an autonomous federal bureaucracy. You have to have one that's responsive to the people. That's the whole point of a democracy. And if you looked at this, if you looked at the founders today and said, what do you think of the way things have turned out? Well, we have this unelected, fourth unconstitutional branch of government, which is the bureaucracy, which has, in a lot of ways, currently more power than any elected representative. And this is not something that people want, and it does not match the will of the people. So it's just something we've got to fix.
Mark Fogel, an American teacher who was deemed wrongfully detained by Russia, has been released in what the White House described as a diplomatic thaw, in fact, that could advance negotiations to even end the war in Ukraine. Now, Steve Witkoff, a special envoy for President Donald Trump, left Russia with Fogel, a history teacher from Pennsylvania, and brought him to the White House straight up, where Trump greeted him. Fogel arrived at the White House as he stood next to Trump with an American flag draped around his shoulders. Fogel, who was expected to be reunited with his family by the end of the day, said he would forever be indebted to Trump. Trump said another American would be released on Wednesday, though he declined to name that person or say what country, only saying it was someone very special. Listen in.
I feel like the luckiest man on earth right now. And I want you to know that I am not a hero in this at all. And President Trump is a hero. These men that came from the diplomatic service are heroes. The senators and representatives that passed legislation in my honor to get me home are the heroes.
Bangladesh's Election Commission has said preparations are underway, in fact, to stage general elections by December this year. This as nationwide vandalisms over the past week prompted the interim Mohammad Yunus government to agree to the proposal. Now, everyone loves a breath of fresh air. Unfortunately, too often our air is anything but fresh. While air quality varies dramatically around the world, about 99% of the global population, in fact, is exposed to air at some point that doesn't meet the strict standards set by the World Health Organization or the WHO, the agency has reported. The UN Health Agency estimates that polluted air laden with noxious gases or tiny invisible particles that burrow into human bodies kills 7 million people prematurely every year. That's right, it kills 7 million people prematurely every year. And for the millions living in some of the world's smoggiest cities, many of them in Asia like New Delhi, Dhaka, Bangkok, and even Jakarta, bad air might seem unescapable. Listen in.
And now keep